Invest Like a Pro, the ultimate guide to growing wealth for FIRE. Introduction: the path to financial independence through smart investing. Welcome to Invest Like a Pro, the ultimate guide to growing wealth for FIRE. If you've picked up this book, chances are you're eager to break free from the traditional 9-to-5 grind and create a life on your terms. The FIRE movement, financial independence, retire early, isn't just a dream, it's a goal that millions of people worldwide are actively pursuing, and investing is one of the most powerful tools to get you there. But let's be honest, investing can feel intimidating. Between the jargon, the market fluctuations, and the seemingly endless choices, it's easy to feel overwhelmed. The good news? You don't need to be a Wall Street expert or have a degree in finance to become a successful investor. What you do need is a clear strategy, the right knowledge, and the discipline to stay the course. That's exactly what this book aims to provide. Why investing is the key to FIRE. While budgeting and frugal living are essential aspects of the FIRE journey, they can only take you so far. The real engine that propels your financial independence is investing. By putting your money to work in the right places, you can achieve exponential growth, outpace inflation, and build a nest egg that supports your lifestyle long after you've left the workforce. Investing isn't just about picking stocks or buying property, it's about creating a balanced, diversified portfolio that aligns with your risk tolerance, time horizon, and financial goals. What you'll learn. This book is your roadmap to investing with confidence. We'll start with the basics, ensuring you have a solid foundation before diving into more complex strategies. You'll learn about the power of index funds. These low-cost, passive investments are the cornerstone of many FIRE portfolios, and for good reason. They offer market-level returns without the stress of stock picking. Real estate investing, from rental properties to REITs, we'll explore how real estate can be a powerful income generator and wealth builder. Alternative investments. Discover how to diversify beyond traditional stocks and bonds, including peer-to-peer lending, cryptocurrencies, and more. Tax optimization. Learn how to keep more of what you earn by leveraging tax-advantaged accounts and strategic tax planning. Sustainable withdrawal strategies. Once you've built your wealth, we'll guide you through the best practices for turning your investments into a reliable income stream that supports your early retirement. Your FIRE journey starts here. This isn't just another investing book, it's a guide tailored for those who want to reclaim their time and live life on their terms. Whether you're just starting your journey or looking to refine your strategy, this book will equip you with the knowledge, tools, and confidence you need to invest like a pro and achieve your FIRE goals. Let's dive in, get inspired, and take the first step towards building the financially independent life you've always dreamed of. Your journey to FIRE starts now. Chapter 1. The Basics of Investing. Building a Solid Foundation. Investing is often perceived as a complex and daunting endeavor, reserved for the rich, the highly educated, or those with connections to Wall Street. However, at its core, investing is simply about making your money work for you rather than you constantly working for your money. Whether you're new to the world of investing or have some experience, understanding the basics is crucial to building a robust foundation for your financial future, especially when your goal is early retirement through the FIRE movement. This chapter will guide you through the fundamental principles of investing, demystify key terms, and explain the essential concepts you need to know to start making informed investment decisions. By the end of this chapter, you'll have a clear grasp of how investing works, why diversification matters, and how you can start building a portfolio that aligns with your goals. 1.1 Understanding Risk and Return, the core of investing. At the heart of every investment decision is a simple trade-off: risk versus return. In investing, risk refers to the possibility of losing some or all of your money. Return, on the other hand, is the profit or loss generated by an investment over time. The relationship between these two concepts is straightforward. The higher the potential return, the higher the risk involved. Conversely, safer investments typically offer lower returns. For instance, a savings account at your local bank is considered low risk because the chance of losing money is minimal. However, the return on a savings account is usually quite low, often failing to keep up with inflation. In contrast, investing in the stock market presents higher risks, such as market downturns and volatility, but historically, it has provided higher returns over the long term. Key takeaway: understanding your personal risk tolerance is crucial when building your investment portfolio. If you're aiming for FIRE, you'll likely need to embrace a certain level of risk to achieve the returns necessary for early retirement. The key is to balance risk and return in a way that suits your financial goals and comfort level. 1.2 Diversification, your best friend in investing. Diversification is the process of spreading your investments across various asset classes, industries, and geographies to reduce risk. The old saying, "Don't put all your eggs in one basket," perfectly captures the essence of diversification. By holding a mix of different types of investments, you can protect your portfolio from significant losses if one particular asset class underperforms. Imagine you invest all your money in a single stock. If that company experiences financial trouble, your entire investment is at risk. However, if you spread your money across various stocks, bonds, real estate, and other assets, your overall portfolio is less likely to suffer catastrophic losses from any single investment. How to diversify effectively. Across asset classes, mix stocks, bonds, real estate, and alternative investments. But within asset classes, even within stocks, diversify by investing in different sectors: technology, healthcare, consumer goods, and geographies, domestic and international. Across investment strategies, combine different approaches such as growth investing, dividend investing, and value investing. Diversification doesn't eliminate risk, but it significantly reduces the impact of any single underperforming asset on your overall wealth. For FIRE enthusiasts, this means your journey to financial independence won't be derailed by unexpected market shifts. 1.3 The magic of compounding, your wealth accelerator. Compounding is often referred to as the eighth wonder of the world, and for a good reason. It's the process that turns small, consistent investments into substantial wealth over time. When you invest, not only does your initial investment earn returns, but those returns also start earning their own returns. This snowball effect accelerates the growth of your portfolio. For example, if you invest $10,000 at an average annual return of 7%, you'll have about $19,672 after 10 years without adding a single extra dollar. If you leave it for 20 years, it grows to approximately $38,697. The real power of compounding comes into play when you contribute regularly to your investments, maximizing the exponential growth. How to maximize compounding. Start early. The sooner you start investing, the more time your money has to grow. Reinvest returns. Always reinvest dividends and interest back into your investments. Stay consistent. Regularly contribute to your portfolio, even in small amounts. For those pursuing FIRE, understanding and leveraging compounding can drastically shorten your time to financial independence, making it one of the most powerful tools in your investment arsenal. 1.4 Investment vehicles. Stocks, bonds, mutual funds, and more. Before you dive into building your portfolio, it's essential to understand the different types of investment vehicles available to you. Stocks. When you buy a stock, you're purchasing a small ownership stake in a company. Stocks offer high potential returns but come with significant volatility. Bonds. Bonds are essentially loans you give to corporations or governments, which pay you back with interest. They are considered lower risk compared to stocks, making them ideal for diversifying your portfolio. Mutual funds and ETFs, exchange-traded funds. These are collections of stocks, bonds, or other assets, managed by professionals. They offer instant diversification and are excellent for those who want a hands-off approach to investing. Real estate. Investing in property can provide rental income and long-term appreciation. Real estate often serves as a hedge against inflation and adds another layer of diversification to your portfolio. Alternative investments. These include assets like commodities, cryptocurrencies, and private equity. While they offer high potential returns, they also carry unique risks and should be approached with caution. Choosing the right mix. For FIRE investors, the ideal portfolio often includes a mix of these investment vehicles, tailored to your risk tolerance, time horizon, and financial goals. As you progress through this book, you'll learn how to fine-tune your investments to best suit your needs. 1.5 The importance of financial education. Investing is not a set-it-and-forget-it endeavor. It requires ongoing education and engagement. Markets evolve, new investment opportunities arise, and your personal circumstances will change over time. Committing to lifelong learning in the realm of investing is crucial to maintaining your financial independence. Resources to enhance your knowledge. Books and blogs. There are countless resources, including classics like The Intelligent Investor by Benjamin Graham, that provide timeless investing wisdom. Podcasts and online courses. Platforms like Coursera and YouTube offer free courses on investing fundamentals. Financial news and market updates. Stay updated on market trends through reputable news sources like Bloomberg, CNBC, and The Wall Street Journal. Investing isn't about chasing the latest trend or trying to time the market. It's about making informed, strategic decisions that align with your long-term goals. With the basics covered, you're now equipped with the knowledge to move forward confidently on your FIRE journey. In the next chapter, we'll delve deeper into one of the most popular investment strategies for FIRE enthusiasts: mastering index funds. Continue your path to financial independence with confidence, knowing you've built a solid investment foundation. Let's dive into the next step together. Chapter 2: Mastering Index Funds, the core of a FIRE portfolio. Index funds have revolutionized the world of investing, offering a simple, low-cost way to achieve broad market exposure without the need to pick individual stocks. For many pursuing financial independence and early retirement, index funds are the backbone of their investment strategy. They provide a straightforward, reliable approach that aligns perfectly with the principles of the FIRE movement: simplicity, efficiency, and maximizing returns over the long term. In this chapter, we will explore why index funds are such a powerful tool for building wealth, how they work, and how to choose the right ones for your FIRE journey. We'll also debunk some common myths, discuss the importance of low fees, and guide you through building a portfolio that can weather market ups and downs with confidence. 2.1 What are index funds and why they work? At their core, index funds are designed to track the performance of a specific market index, such as the S&P 500, which includes the 500 largest publicly traded companies in the U.S. When you invest in an index fund, you are essentially buying a tiny slice of every company within that index. This means that instead of trying to pick individual winners, you are betting on the overall growth of the market. The beauty of index funds lies in their passive nature. Unlike actively managed funds, which employ teams of analysts and managers attempting to outperform the market, index funds simply aim to match the market. This passive approach has two significant advantages: lower fees and more consistent performance. Historically, most actively managed funds fail to beat their benchmark indexes over the long term. This is partly due to higher management fees and the challenges of predicting market movements accurately. Index funds, on the other hand, eliminate the need for constant buying and selling, reducing costs and allowing your investments to grow steadily over time. Investing in index funds means putting your faith in the long-term upward trajectory of the market, rather than relying on the skill of individual fund managers. This approach has proven time and again to be a winning strategy, especially for those seeking financial independence. 2.2 The power of low fees, keeping more of your money. One of the key reasons index funds are so popular among FIRE enthusiasts is their low cost. Every investment comes with expenses, known as the expense ratio, which covers the management and operation of the fund. In actively managed funds, these costs can be substantial, often eating into your returns over time. Index funds, however, typically have much lower expense ratios, sometimes as low as 0.03% per year. This means more of your money stays invested and continues to compound. Let's put this into perspective. Imagine you have $100,000 invested in a fund with an expense ratio of 1%, a typical fee for many actively managed funds. You'd pay $1,000 per year in fees, regardless of whether your fund makes money or not. Over 10 years, those fees could add up to tens of thousands of dollars lost to fund management. In contrast, an index fund with an expense ratio of 0.03% would only cost you $30 per year, allowing more of your hard-earned money to stay invested and grow. Low fees are particularly critical for those pursuing FIRE because the compounding effect of fees over decades can significantly impact the size of your retirement portfolio. By choosing low-cost index funds, you minimize this drag on your returns and maximize your ability to grow wealth. 2.3 How to choose the right index funds for your FIRE portfolio. Selecting the right index funds is a key step in crafting a portfolio that aligns with your FIRE goals. The options can be overwhelming, but understanding the differences between various types of index funds will help you make informed choices. Here are some key factors to consider. Market coverage. The most popular index funds track major indexes like the S&P 500, which gives you exposure to large-cap U.S. companies. However, diversifying beyond just one index can help reduce risk. Consider adding funds that track small-cap stocks, international markets, or other asset classes like bonds. This broader exposure will help balance your portfolio, ensuring that you're not overly reliant on the performance of a single sector or geography. Sector and industry focus. Some index funds specialize in specific sectors such as technology, healthcare, or energy. While these can offer higher growth potential, they also come with increased risk due to their concentrated nature. If you choose to include sector-specific funds, make sure they complement your broader market holdings rather than dominate your entire portfolio. Bond index funds. While stocks are the primary driver of growth in most FIRE portfolios, bonds play a crucial role in providing stability and income, especially as you near retirement. Bond index funds offer a simple way to add fixed income exposure to your portfolio, helping to balance the risk of your stock holdings. Expense ratios. Always compare expense ratios before choosing a fund. Even among index funds, fees can vary. Opt for funds with the lowest possible expense ratios to keep your costs minimal and your returns maximized. Tracking error. This is a lesser-known metric that indicates how closely a fund tracks its underlying index. A high tracking error means the fund's performance diverges significantly from the index it's supposed to follow, which can be a red flag. Look for funds with low tracking errors to ensure that you're getting the market exposure you expect. Choosing the right mix of index funds is a personal decision that depends on your risk tolerance, investment timeline, and specific FIRE goals. The key is to build a diversified portfolio that gives you broad market exposure, minimizes fees, and matches your desired level of risk. 2.4 Common myths about index funds debunked. Despite their popularity, index funds are often misunderstood. Let's clear up some common misconceptions. Myth 1. Index funds are only for beginners. Many believe that index funds are a starting point for novice investors and that serious investors should move on to picking individual stocks. This couldn't be further from the truth. Some of the world's most successful investors, including Warren Buffett, advocate for index funds because of their simplicity, cost-effectiveness, and proven track record. Myth 2. Index funds are too slow to grow wealth. Critics often argue that index funds are too conservative and that picking individual stocks or active funds will yield higher returns. While it's true that individual stocks can sometimes provide spectacular gains, they also come with higher risk. Index funds provide steady, reliable growth over the long term, which is exactly what you need when planning for decades of financial independence. Myth 3. You can't beat the market with index funds. The goal of index funds is not to beat the market but to match it. And matching the market is often better than trying, and usually failing, to outperform it. The low fees and consistent performance of index funds often result in better net returns than those of actively managed funds over the long haul. 2.5 Building a long-term strategy with index funds. The beauty of index funds lies not just in their simplicity but also in their alignment with the long-term mindset essential for FIRE. Instead of trying to time the market or constantly adjust your portfolio based on the latest news, index fund investing allows you to adopt a set-it-and-forget-it approach. By regularly contributing to your index fund portfolio, you can take advantage of dollar-cost averaging, buying more shares when prices are low and fewer when prices are high. This strategy smooths out the effects of market volatility over time. Additionally, index funds make it easy to stick to your investment plan during market downturns, as there is no temptation to tweak your portfolio based on short-term performance. This disciplined approach can make a significant difference in your overall returns, helping you stay on track to achieve your FIRE goals. 2.6 The future of index funds. Staying adaptable. While index funds are a tried-and-true strategy, the investment landscape is always evolving. New funds are constantly being developed to meet the changing needs of investors, including those focusing on ESG, environmental, social, and governance criteria, factor-based investing, or specific themes like technology or clean energy. For those pursuing FIRE, it's important to stay informed about new opportunities while maintaining a solid core of traditional index funds. This approach allows you to benefit from emerging trends without compromising the stability and simplicity of your portfolio. Index funds offer a powerful, reliable path to building wealth, making them an essential component of any FIRE strategy. By focusing on low fees, broad diversification, and a long-term mindset, you can harness the full potential of the market and accelerate your journey to financial independence. In the next chapter, we'll explore how real estate can complement your index fund investments, adding another layer of income and growth potential to your FIRE portfolio. Let's continue to build your investment knowledge and take the next step towards mastering your financial destiny. Chapter 3: Real Estate for FIRE, Building Wealth with Property. Real estate is a cornerstone of many successful FIRE strategies, offering unique benefits that go beyond what traditional stocks and bonds can provide. For many FIRE enthusiasts, real estate represents not just an investment, but a pathway to passive income, financial security, and even a hedge against inflation. When done right, investing in property can accelerate your journey to financial independence by creating streams of income that are resilient to market fluctuations. However, real estate investing is not without its challenges. It requires a more hands-on approach compared to passive index fund investing and involves a deeper understanding of market dynamics, property management, and financial planning. In this chapter, we'll delve into the different ways you can invest in real estate, how to assess properties, the risks involved, and strategies to maximize your returns. Whether you're considering purchasing rental properties, flipping homes, or investing in real estate through less direct methods, this guide will help you navigate the world of real estate with confidence. 3.1 Why real estate? The unique benefits of property investment. Real estate has a unique set of characteristics that make it an attractive investment option for those pursuing FIRE. First and foremost, real estate provides tangible value. You can see it, touch it, and use it, unlike stocks or bonds. This tangibility often gives investors a greater sense of security, knowing that their investment has intrinsic value regardless of market conditions. Another key benefit is the ability to generate consistent, passive income through rental properties. Unlike stocks, which typically require you to sell shares to realize gains, real estate allows you to earn income while still holding onto your asset. This income can be a game changer for early retirees, providing a reliable stream of cash flow that can cover living expenses without needing to dip into your investment principal. Additionally, real estate offers significant tax advantages, including deductions for mortgage interest, property taxes, depreciation, and other expenses. These tax benefits can substantially reduce your taxable income, allowing you to keep more of your earnings and reinvest in further property acquisitions or other investments. Perhaps one of the most powerful aspects of real estate is the opportunity to leverage other people's money to grow your wealth. By using a mortgage, you can control a valuable asset with a relatively small upfront investment, amplifying your returns when property values appreciate. This leverage is one of the main reasons why real estate can outpace other investments in terms of wealth-building potential, especially when combined with careful management and strategic planning. 3.2 The different paths to real estate investment. There are multiple ways to get involved in real estate, each with its own set of advantages, risks, and levels of involvement. Understanding these options will help you choose the path that aligns best with your FIRE goals, resources, and risk tolerance. 1. Direct ownership of rental properties. Buying rental properties is perhaps the most direct way to invest in real estate. This approach involves purchasing a property, such as a single-family home, duplex, or multifamily building, and renting it out to tenants. Rental properties can generate consistent monthly income and, over time, appreciate in value, building your wealth. The key to success with rental properties is thorough research. You'll need to evaluate potential properties based on location, condition, rental demand, and cash flow projections. It's important to calculate your expected returns accurately, factoring in mortgage payments, maintenance costs, property taxes, and management fees. Owning rental properties also means taking on the role of a landlord, which involves tenant management, property upkeep, and handling emergencies. While these responsibilities can be outsourced to a property manager, doing so will impact your overall profitability. 2. Real estate investment trusts, REITs. For those who want exposure to real estate without the hassle of direct ownership, real estate investment trusts, REITs, are an excellent option. REITs are companies that own, operate, or finance income-producing real estate across various sectors, including residential, commercial, and industrial properties. By investing in REITs, you can gain access to real estate investments through the stock market, enjoying the benefits of diversification, liquidity, and passive income from dividends. REITs are particularly attractive because they are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This makes them a great choice for generating income, especially in a FIRE portfolio where consistent cash flow is essential. REITs also offer a way to invest in types of real estate that might otherwise be out of reach, such as large office complexes, shopping malls, or healthcare facilities. 3. Real estate crowdfunding and peer-to-peer platforms. Recent technological advancements have opened up new opportunities in real estate through crowdfunding and peer-to-peer platforms. These platforms allow investors to pool their money to fund real estate projects, ranging from single-family home flips to large-scale commercial developments. This approach provides an entry point for investors with smaller amounts of capital and offers the potential for higher returns compared to traditional REITs. Crowdfunding investments can be either debt-based, where you lend money to the developer and earn interest, or equity-based, where you own a share of the property and earn returns based on its performance. However, these investments often come with higher risk, as they are less liquid and may involve projects that are more speculative in nature. 4. House hacking, turning your home into an investment. House hacking is a creative strategy that allows you to live in your investment property while generating income from it. This can be done by purchasing a multifamily property such as a duplex or triplex, and living in one unit while renting out the others. Alternatively, you could rent out rooms in your home or even use platforms like Airbnb to generate short-term rental income. House hacking can significantly reduce or even eliminate your housing costs, allowing you to save and invest more aggressively towards your FIRE goals. It's a strategy that combines the best of both worlds, an affordable place to live and a source of income. 3.3 Evaluating real estate deals. Finding the right property. Successful real estate investing starts with finding the right property. This involves more than just picking a house in a nice neighborhood. It requires a careful analysis of numbers, market conditions, and future potential. Key factors to consider include location, rental demand, and the property's cash flow potential. Location is perhaps the most critical factor. A property in a desirable location with good schools, employment opportunities, and amenities will attract more reliable tenants and command higher rents. Properties in areas with strong economic growth, low crime rates, and planned infrastructure improvements tend to appreciate faster and offer more stable returns. Cash flow is the lifeblood of rental property investing. Before purchasing, you must ensure the property will generate positive cash flow. That is, the income from rent should exceed all expenses including mortgage payments, property taxes, insurance, maintenance, and property management fees. Positive cash flow not only provides you with income but also acts as a buffer during economic downturns or when unexpected costs arise. The 1% rule is a quick way to screen properties. This rule suggests that a rental property should generate at least 1% of the purchase price in monthly rent. For example, a property costing $200,000 should ideally rent for at least $2,000 per month. While not a definitive measure, it helps investors quickly filter out properties that may not meet their financial criteria. Appreciation potential is also vital. While cash flow provides immediate income, appreciation adds long-term wealth. Researching local market trends such as population growth, job market health, and planned developments can give you insight into the future value of a property. 3.4 Managing properties. The good, the bad, and the profitable. Owning rental properties comes with the responsibility of managing them effectively. This includes finding and screening tenants, handling repairs and maintenance, and ensuring the property complies with local regulations. Good management can make the difference between a profitable investment and a financial drain. Screening tenants is crucial. Choosing reliable, long-term renters minimizes vacancy rates and reduces the risk of property damage. Conduct thorough background checks, verify employment and income, and consider rental history to find tenants who are likely to pay on time and take care of the property. Maintenance is another critical aspect. Regular upkeep not only preserves the property's value but also keeps tenants satisfied and willing to renew their leases. Proactive management such as seasonal inspections and prompt response to repair requests can prevent small issues from turning into costly problems. For those who prefer a hands-off approach, hiring a property manager can relieve much of the day-to-day stress. Property managers handle everything from tenant placement to maintenance, allowing you to focus on growing your portfolio. While they charge a fee, typically around 8 to 12% of the monthly rent, the peace of mind and time saved can be well worth the cost. 3.5 Risks and challenges. What to watch out for. While real estate offers great rewards, it also comes with its share of risks. Market downturns, vacancies, unexpected repairs, and difficult tenants are just some of the challenges investors face. Understanding these risks and having strategies in place to mitigate them is essential. Economic downturns can impact property values and rental demand. Diversifying your portfolio geographically and investing in properties with solid cash flow can help weather these storms. It's also wise to maintain an emergency fund for each property to cover unexpected expenses and periods of vacancy. Tenant issues such as late payments or property damage can also be a headache. Having a thorough screening process, a solid lease agreement, and a plan for handling disputes can minimize these risks. Finally, the upfront costs of buying property, including down payments, closing costs, and renovation expenses, can be substantial. It's crucial to budget carefully and avoid over-leveraging yourself with too much debt. Real estate investing requires patience and discipline, but the rewards can be life-changing. 3.6 Real estate as part of your FIRE strategy. Real estate can play a pivotal role in your overall FIRE strategy, providing both immediate income and long-term wealth. By carefully selecting properties, managing them effectively, and leveraging the unique benefits of real estate, you can build a portfolio that not only supports your financial independence goals but also provides a safety net against market volatility. The combination of steady cash flow, tax advantages, and potential appreciation makes real estate a powerful tool for those pursuing early retirement. However, success in real estate requires education, due diligence, and a willingness to adapt to changing market conditions. As you build your FIRE plan, consider how real estate can complement your other investments, adding another layer of stability and income to your journey towards financial freedom. In the next chapter, we will shift our focus to the stock market, exploring strategies for selecting individual stocks, building a diversified portfolio, and maximizing your returns while managing risk. Let's continue to expand your financial toolkit and take the next step towards investing like a pro. Chapter 4: Stock Market Strategies, from individual stocks to ETFs. Investing in the stock market is one of the most direct paths to building wealth and achieving financial independence. While index funds and real estate provide solid foundations, there's something uniquely powerful about the stock market: the potential for high returns, the ability to invest in some of the world's most innovative companies, and the flexibility to tailor your portfolio to your specific goals and risk tolerance. However, investing in the stock market requires knowledge, strategy, and a disciplined approach. Unlike passive investing in index funds, picking individual stocks or navigating the array of available ETFs, exchange-traded funds, involves more decision-making and risk management. The rewards can be significant, but the potential pitfalls are real, making it essential to approach stock investing with a well-thought-out plan. In this chapter, we'll dive deep into stock market strategies tailored for those on the FIRE path. You'll learn how to research and select individual stocks, understand the role of ETFs, explore dividend investing, and manage your portfolio with a focus on maximizing returns while keeping risk in check. Whether you're new to stock investing or looking to refine your strategy, this chapter will arm you with the tools you need to navigate the market with confidence. 4.1 Understanding the stock market, the engine of wealth creation. The stock market is often seen as the beating heart of the economy, a place where companies raise capital to grow and where investors can participate in that growth by purchasing shares. At its core, the stock market is a marketplace where shares of publicly traded companies are bought and sold. When you buy a stock, you are buying a small piece of that company, making you a part owner with a claim on its profits. The potential of the stock market lies in the ability of companies to generate profits, innovate, and grow over time. This growth is reflected in rising stock prices, and as a shareholder, you benefit from both the appreciation of your shares and any dividends the company might pay. Historically, the stock market has outperformed other asset classes like bonds and real estate over the long term, making it a crucial component of any FIRE portfolio. However, the market is also volatile. Prices can swing wildly based on economic news, company performance, and investor sentiment. Understanding these dynamics, and how to navigate them, is key to becoming a successful investor. 4.2 Picking individual stocks, balancing opportunity and risk. Investing in individual stocks offers the potential for high returns, but it also comes with higher risk compared to diversified index funds or ETFs. To succeed, you need to develop the skills to identify companies with strong growth potential, solid fundamentals, and sound management. This process, known as stock analysis, involves both quantitative and qualitative assessments. Fundamental analysis is the cornerstone of stock picking. It involves evaluating a company's financial health, including its earnings, revenue growth, profit margins, debt levels, and cash flow. Key financial ratios, such as the price-to-earnings (PE) ratio, return on equity (ROE), and debt-to-equity ratio, provide insights into a company's valuation, efficiency, and financial stability. A company with strong financials, consistent revenue growth, and manageable debt levels is generally seen as a good investment prospect. But numbers alone don't tell the whole story. Qualitative analysis is equally important, focusing on factors that can't be easily quantified, such as the company's business model, competitive advantages, industry trends, and the quality of its management team. Companies with strong brand recognition, innovative products, or dominant market positions often have a higher chance of long-term success. Investors also need to consider the broader economic environment. Interest rates, inflation, and geopolitical events can all impact stock prices, often in unpredictable ways. While it's impossible to foresee every market movement, understanding these macroeconomic factors can help you make more informed investment decisions. 4.3 Diversification with ETFs, a middle ground. For investors who want the benefits of stock investing without the high risk of picking individual companies, ETFs offer a compelling alternative. ETFs are investment funds that trade on stock exchanges, much like individual stocks, but they hold a basket of assets, often hundreds or thousands of stocks within a single fund. This structure provides instant diversification, reducing the risk associated with holding a concentrated position in a single company. ETFs come in many varieties, including those that track major indexes like the S&P 500, sector-specific ETFs that focus on industries such as technology or healthcare, and even thematic ETFs that target trends like clean energy or artificial intelligence. This flexibility allows investors to gain targeted exposure to areas of the market they believe will perform well, without needing to pick individual winners. One of the key advantages of ETFs is their low cost. Most ETFs have significantly lower fees than actively managed mutual funds, making them an efficient way to gain market exposure. They also offer high liquidity, meaning you can buy and sell ETF shares at any time during market hours just like stocks. This liquidity and flexibility make ETFs a valuable tool for those pursuing FIRE, allowing you to adjust your portfolio easily as your goals and market conditions change. 4.4 Dividend Investing. Turning stocks into income. Dividend investing is a popular strategy among FIRE enthusiasts, particularly for those seeking a reliable income stream in early retirement. Dividends are payments that companies distribute to their shareholders, usually derived from profits. While not all companies pay dividends, those that do tend to be established firms with stable cash flows, such as those in the utilities, consumer goods, and healthcare sectors. The appeal of dividend stocks lies in their ability to generate cash flow without the need to sell shares. This can be especially valuable in retirement, as it provides income while allowing your portfolio to continue growing. High-quality dividend stocks often have a track record of paying and increasing dividends over time, which not only helps to keep pace with inflation but also provides a sense of financial stability. When selecting dividend stocks, it's important to focus on companies with sustainable payout ratios, meaning they pay out a manageable portion of their earnings as dividends. A company with a payout ratio above 100% is paying more in dividends than it earns, which is usually a red flag. Instead, look for companies with moderate payout ratios, strong earnings growth, and a commitment to maintaining or increasing their dividends. Dividend aristocrats, companies that have increased their dividends for 25 consecutive years or more, are often a good starting point for dividend investors. These companies such as Johnson & Johnson, Coca-Cola, and Procter & Gamble have proven their ability to reward shareholders through thick and thin, making them reliable income generators. 4.5 Growth versus Value Investing. Finding your strategy. One of the key decisions investors face is choosing between growth and value investing. Growth investing focuses on companies that are expected to grow at an above-average rate compared to other companies. These are often firms in dynamic sectors like technology, biotechnology, or renewable energy. Growth stocks tend to reinvest profits back into the business rather than paying dividends, aiming for rapid expansion and increased market share. While growth stocks offer the potential for substantial capital appreciation, they can also be more volatile, as their high valuations are often tied to future expectations. If a growth company fails to meet market expectations, its stock price can drop sharply. Value investing, on the other hand, involves seeking out companies that appear to be undervalued by the market. These stocks may be out of favor due to temporary setbacks, economic downturns, or broader market trends, but their underlying businesses remain solid. Value investors look for diamonds in the rough, believing that the market will eventually recognize the true worth of these companies, resulting in price appreciation. Both strategies have their merits, and many successful investors use a blend of growth and value stocks to balance their portfolios. For FIRE investors, the choice between growth and value should be guided by your risk tolerance, time horizon, and financial goals. A younger investor with a longer timeline may lean more towards growth, while someone closer to retirement might prioritize the stability and income potential of value stocks. 4.6 Managing Market Volatility. Staying the course. The stock market is inherently volatile. Prices can swing due to earnings reports, economic data, geopolitical tensions, or even social media buzz. For investors, especially those new to the market, these ups and downs can be unsettling. However, market volatility is not something to fear, it's something to understand and manage. One of the most critical skills in stock investing is learning to stay calm during market downturns. When stocks drop, the instinctive reaction is often to sell and cut losses. However, this behavior, known as panic selling, locks in losses and can derail your investment strategy. Instead, remind yourself of the long-term nature of your FIRE goals. Historically, the stock market has rebounded from every downturn, rewarding those who stay invested. A disciplined approach, such as dollar-cost averaging, can help mitigate the impact of market volatility. By consistently investing a fixed amount of money at regular intervals, you buy more shares when prices are low and fewer when prices are high. Over time, this strategy reduces the average cost per share and helps smooth out the bumps in the road. Rebalancing your portfolio periodically is another important aspect of managing risk. As certain stocks or sectors outperform, they can grow to represent a larger portion of your portfolio, increasing your overall risk. Rebalancing involves selling some of the outperforming assets and reinvesting in underperforming ones to maintain your desired asset allocation. This disciplined approach helps keep your portfolio aligned with your risk tolerance and financial goals. 4.7 The psychological game. Mastering your emotions. Investing is as much about psychology as it is about numbers. Fear and greed are powerful emotions that can drive market behavior and influence individual decision-making. Fear can cause investors to sell during downturns, missing out on potential rebounds. Greed, on the other hand, can lead to chasing high-flying stocks or jumping on speculative trends without proper analysis. To succeed in stock investing, it's crucial to develop emotional discipline. This means having a clear investment plan, setting realistic expectations, and sticking to your strategy even when the market tests your resolve. Avoid the temptation to time the market or make impulsive decisions based on headlines. Instead, focus on the fundamentals of your investments and remember why you chose them in the first place. Setting specific rules, such as predetermined buy and sell points, can help remove emotions from the equation. It's also helpful to periodically review your investment thesis for each stock. If the reasons you bought it still hold true, there's little need to react to short-term price movements. 4.8 Building your stock portfolio. A step-by-step approach. Constructing a stock portfolio that aligns with your FIRE goals involves more than just picking a few companies. It's about creating a balanced, diversified mix that reflects your risk tolerance, time horizon, and income needs. Start by defining your investment objectives, whether it's growth, income, or a blend of both, and then select stocks, ETFs, and other assets that meet these criteria. Diversification is key. A well-rounded portfolio might include a mix of blue-chip stocks, high-growth companies, reliable dividend payers, and sector-specific ETFs. The goal is to create a portfolio that can perform well across different market conditions, reducing your overall risk while maximizing potential returns. Regularly monitor your portfolio, but avoid the temptation to overreact to short-term movements. The stock market is a powerful tool for building wealth, but it rewards patience, discipline, and a long-term perspective. By focusing on high-quality investments, maintaining diversification, and staying committed to your strategy, you can harness the full potential of the market to achieve your financial independence goals. As we move forward, remember that stock investing is not about perfection, it's about progress. Each decision, whether it leads to a gain or a lesson learned, is a step towards mastering the market and securing your financial future. In the next chapter, we'll explore the power of compound interest and how to leverage it as the ultimate accelerator on your path to FIRE. Stay focused, stay informed, and let's continue to build the knowledge that will empower you to invest like a pro. Chapter 5. The Power of Compound Interest, Accelerating Your Growth. If there's one concept that stands out as the ultimate wealth builder in the world of investing, it's compound interest. Often referred to as the eighth wonder of the world, compound interest is the engine that drives your money to grow exponentially over time. For those on the path to financial independence, understanding and harnessing the power of compounding can be a game changer, turning modest savings into substantial wealth. Unlike simple interest, which only earns returns on the initial principal, compound interest earns returns on both your original investment and on the returns that accumulate over time. This self-reinforcing cycle of growth is what makes compounding so powerful. The earlier you start investing and the more consistently you contribute, the more you can take advantage of this remarkable force. In this chapter, we'll explore how compound interest works, the factors that influence its effectiveness, and practical strategies to maximize its potential in your journey to FIRE. 5.1 The Mechanics of Compound Interest, How It Works. To truly appreciate the power of compound interest, it helps to understand how it works in practice. When you invest money, your returns, whether from interest, dividends, or capital gains, are reinvested into your account. This reinvestment allows your returns to generate their own returns, creating a snowball effect that accelerates your portfolio's growth. Over time, the impact of compounding becomes increasingly significant, especially as your investment horizon extends into decades. Consider this simple example. Suppose you invest $10,000 at an annual return rate of 7%, which is roughly the historical average for the stock market. In the first year, you earn $700, bringing your total to $10,700. In the second year, you earn 7% not just on your original $10,000 but on the entire $10,700, resulting in $749 in earnings. This cycle continues, with each year's gains building on the previous year's total. Now, imagine the effect of compounding over 30 or 40 years. Without adding any additional money, your initial $10,000 investment could grow to nearly $76,000 after 30 years, simply by letting compounding do its work. Add regular contributions to this equation, say $200 a month, and the results become even more impressive. With consistent investing, your portfolio could grow to well over $350,000 in the same period, showcasing the immense power of steady contributions combined with compound interest. 5.2 Time, the most powerful variable in compounding. Time is the most crucial factor in the equation of compound interest. The longer your money has to grow, the more dramatic the compounding effect becomes. This is why starting early, even with small amounts, can be incredibly advantageous. The more time your investments have to compound, the less you need to rely on high returns or large contributions to reach your financial goals. Let's compare two investors. Investor A starts investing $200 a month at age 25, while Investor B starts at age 35, investing the same amount monthly. Assuming a 7% annual return, Investor A will have over $480,000 by age 65, while Investor B will have only about $240,000, half as much, even though they both invested the same monthly amount. This stark difference is entirely due to the additional 10 years of compounding that Investor A benefited from. Starting early doesn't just apply to young investors. It's a principle that underscores the importance of not delaying your investments, no matter your age. Even if you're getting a late start, the sooner you begin, the more you can capitalize on compounding to grow your wealth. Time in the market is far more critical than timing the market. Attempting to jump in and out based on market predictions usually results in missing key growth periods, undermining the compounding effect. 5.3 Regular contributions, fuel for the compounding engine. While time is the foundation of compounding, regular contributions act as the fuel that powers this engine. Consistently adding to your investments not only increases your principal amount but also accelerates the compounding process. Even modest monthly contributions can have a significant impact when combined with long-term compounding. One of the best ways to ensure regular contributions is through automation. Setting up automatic transfers from your bank account to your investment accounts takes the decision-making out of the process, helping you stay disciplined and consistent. This approach is particularly valuable during market downturns when emotions can lead to hesitation or withdrawal. By automating your contributions, you maintain your commitment to investing regardless of market conditions, maximizing your growth potential over time. Dollar cost averaging, a strategy that involves investing a fixed amount of money at regular intervals, is an excellent way to automate contributions. This method allows you to buy more shares when prices are low and fewer when prices are high, effectively reducing your average cost per share over time. Not only does this strategy align with the principles of compound interest, but it also helps smooth out the effects of market volatility, keeping your investments on track. 5.4 Reinvesting returns, maximizing the compounding effect. Reinvesting your returns, whether from dividends, interest, or capital gains, is a critical component of maximizing compound growth. When you reinvest returns, you're putting your earnings back to work, compounding them alongside your initial investment. This reinvestment strategy amplifies the overall growth of your portfolio, creating a self-sustaining cycle of increasing returns. Dividends, in particular, play a powerful role in compounding. Many companies pay dividends to shareholders as a way of distributing profits, and reinvesting these dividends can significantly boost your long-term returns. Dividend reinvestment programs, DRIPs, offered by many brokerages make this process seamless, automatically buying more shares of the stock with your dividend payments at no additional cost. Consider the impact of dividend reinvestment on a stock that yields 4% annually. Without reinvestment, you would receive cash dividends each year, providing a nice income but no additional growth beyond share price appreciation. With reinvestment, however, your dividends purchase more shares, which in turn generate their own dividends, exponentially increasing your future income and total returns. The same principle applies to other types of investment returns. Reinvesting interest payments from bonds or capital gains from selling appreciated assets keeps your money compounding, maximizing the growth of your portfolio over time. 5.5 The impact of fees, minimizing costs to enhance compounding. While compounding is a powerful force, its effectiveness can be significantly reduced by high fees. Investment fees, including management fees, trading commissions, and expense ratios, directly eat into your returns, slowing the compounding process. Over time, even small fees can add up, costing you tens or even hundreds of thousands of dollars in lost growth. To minimize the impact of fees, focus on low-cost investment options like index funds and ETFs, which typically have much lower expense ratios compared to actively managed funds. For instance, an actively managed mutual fund might charge a 1% annual fee, while a comparable index fund might charge just 0.05%. While the difference seems small over decades, this disparity can lead to vastly different outcomes due to the compounding effect of the lower fee structure. Additionally, be mindful of hidden costs like trading fees and tax implications. Frequent buying and selling of investments can generate significant transaction costs and capital gains taxes, which reduce the amount of money that stays invested and compounds. Adopting a long-term buy-and-hold strategy helps keep fees and taxes low, allowing your investments to grow more efficiently. 5.6 Inflation, the silent compounding killer. Inflation is often called the silent killer of wealth because it erodes the purchasing power of your money over time. While compounding grows your investments, inflation works in the opposite direction, slowly eating away at your real returns. To ensure that your money retains its value, your investments must grow at a rate that outpaces inflation. This is one of the reasons why investing in assets like stocks, real estate, and certain bonds is crucial for those pursuing FIRE. These assets have historically provided returns that exceed inflation, preserving and growing your purchasing power. Holding too much cash or investing heavily in low-yield assets like savings accounts or traditional bonds can cause your wealth to lose value in real terms, undermining your financial independence goals. Understanding the impact of inflation reinforces the importance of long-term investing and compounding. By choosing growth-oriented investments that beat inflation and maintaining a disciplined approach, you can protect your wealth from the eroding effects of rising prices. 5.7 The Snowball Effect. Compounding as a life strategy. Beyond investing, the principles of compounding can be applied to other areas of life, creating a snowball effect of positive change. Just as money compounds, so too can habits, skills, and relationships. Small, consistent actions in any area, whether it's saving, learning, or building connections, can lead to substantial progress over time. Consider your financial habits. Consistently saving a portion of your income, no matter how small, builds a habit that reinforces your long-term wealth-building strategy. The discipline of budgeting, cutting unnecessary expenses, and prioritizing investments compounds into a lifestyle that supports financial independence. Similarly, investing in your knowledge compounds. Every book you read, course you take, or skill you acquire adds to your ability to make informed decisions, navigate challenges, and seize opportunities. Just as with financial investments, the returns on personal development are exponential, expanding your capacity to achieve your goals. Even relationships benefit from the power of compounding. Building a network of supportive, like-minded individuals can open doors, provide mentorship, and create opportunities that wouldn't exist otherwise. The connections you make today can lead to lifelong benefits that compound in ways you might never anticipate. 5.8 Maximizing compounding in your FIRE strategy. For those on the FIRE journey, maximizing the power of compounding is not just a financial strategy, it's a mindset. It's about recognizing that every small step, every dollar invested, and every decision made today contributes to a much larger future outcome. The key is to stay consistent, remain patient, and let time work in your favor. Set clear goals for your investments, automate your contributions, and make compounding a priority in your financial plan. Reinvest your returns, minimize fees, and maintain a long-term perspective, even when the market fluctuates. Remember that the magic of compounding doesn't happen overnight. It's the result of steady, incremental growth that accelerates with each passing year. As we continue on this journey, keep the principles of compounding at the forefront of your strategy. They are the foundation of building lasting wealth and achieving financial independence. In the next chapter, we will explore alternative investments, beyond stocks and real estate, that can further diversify your portfolio and enhance your compounding potential. Stay committed, keep learning, and let the power of compounding propel you toward your financial freedom. Let's move forward with confidence as we expand your investment knowledge and continue to build the future you've envisioned. Chapter 6. Alternative Investments, Beyond Stocks and Real Estate. While stocks and real estate are foundational pillars of many FIRE portfolios, the world of investing offers much more than these traditional assets. Alternative investments, ranging from precious metals to cryptocurrencies, peer-to-peer lending, and beyond, present opportunities to diversify your portfolio, hedge against market downturns, and tap into unique sources of growth. These investments can serve as valuable complements to your core holdings, adding layers of resilience, income, and potential high returns. Alternative investments often operate independently of the stock market's ups and downs, providing a counterbalance that can stabilize your portfolio during periods of volatility. However, these assets also come with their own set of risks, complexities, and requirements for due diligence. In this chapter, we'll explore a range of alternative investments, examining their benefits, drawbacks, and the role they can play in your overall FIRE strategy. Whether you're looking to hedge against inflation, generate additional income, or simply diversify your risk, alternative investments can offer powerful solutions. 6.1 Precious Metals. A timeless hedge against uncertainty. Precious metals such as gold, silver, and platinum have been used as stores of value for centuries. These tangible assets serve as a hedge against economic uncertainty, inflation, and currency devaluation. Unlike stocks or bonds, precious metals are not tied to the performance of any one company or government, making them a popular choice for investors seeking stability in turbulent times. Gold, often seen as the ultimate safe haven asset, tends to perform well during periods of market volatility and economic crisis. Its value is driven by scarcity, durability, and universal recognition as a store of wealth. While gold doesn't generate income like stocks or real estate, it provides a defensive position that can help protect your portfolio when other investments falter. Silver, though often overshadowed by gold, offers similar hedging benefits with additional industrial uses, ranging from electronics to solar panels. This dual role makes silver more volatile but also presents opportunities for growth driven by technological advancements and industrial demand. Investing in precious metals can be done through various means, including physical ownership of bullion and coins, ETFs that track metal prices, or mining stocks. Each option has its pros and cons. Physical metals provide direct ownership but come with storage and security considerations, while ETFs and mining stocks offer liquidity but introduce additional market and management risks. 6.2 Cryptocurrencies. The digital frontier of investing. Cryptocurrencies, led by Bitcoin and Ethereum, have emerged as one of the most disruptive forces in modern finance. These digital assets operate on decentralized networks, offering an alternative to traditional currencies and payment systems. For many, cryptocurrencies represent not just an investment, but a revolutionary shift toward a more transparent, accessible, and efficient financial system. The appeal of cryptocurrencies lies in their potential for significant price appreciation, driven by technological innovation, increasing adoption, and the scarcity of certain coins. Bitcoin, often referred to as digital gold, has gained recognition as a store of value, with a fixed supply that resists inflation. Ethereum, on the other hand, powers a vast ecosystem of decentralized applications, enabling smart contracts, decentralized finance, DeFi, and non-fungible tokens, NFTs. However, the volatility of cryptocurrencies is both a feature and a risk. Prices can fluctuate wildly within short periods, influenced by regulatory news, technological developments, and market sentiment. Investing in cryptocurrencies requires a high tolerance for risk and a willingness to accept the possibility of significant losses alongside potential gains. For FIRE investors, cryptocurrencies can offer diversification and exposure to an emerging asset class that behaves differently from stocks, bonds, and real estate. However, it's crucial to approach this market with caution, thorough research, and a long-term perspective. Many experts recommend limiting cryptocurrency exposure to a small percentage of your overall portfolio, enough to participate in potential upside without jeopardizing your core investment strategy. 6.3 Peer-to-peer lending, earning income through direct loans. Peer-to-peer (P2P) lending platforms have democratized the lending process, allowing individuals to lend money directly to borrowers, bypassing traditional banks. These platforms connect investors with personal, business, or real estate loans, offering an opportunity to earn interest income that often exceeds what's available through traditional savings accounts or bonds. The appeal of P2P lending lies in its potential for high returns and the ability to diversify across multiple loan types and risk profiles. By lending small amounts to many different borrowers, investors can spread risk and create a steady stream of passive income. Platforms such as Lending Club, Prosper, and Fundrise have made P2P lending accessible to individual investors, providing detailed information on borrower creditworthiness, loan terms, and projected returns. However, P2P lending is not without risks. Borrower defaults can erode returns, particularly in times of economic stress. Unlike bank deposits, P2P loans are not insured, meaning investors bear the full risk of loss. It's essential to conduct due diligence on each platform, understand the credit risk associated with different loan grades, and diversify your investments to minimize the impact of defaults. For those pursuing FIRE, P2P lending can be a valuable source of income, offering regular cash flow that can be reinvested to enhance the compounding effect. The key is to approach this space with a well-defined strategy, focusing on quality loans, diversification, and ongoing monitoring to manage risk effectively. 6.4 Private equity and venture capital. High risk, high reward. Private equity and venture capital represent the pinnacle of alternative investments, offering access to early-stage companies, startups, and private businesses that are not publicly traded. These investments provide the potential for substantial returns but also come with significant risk, high entry barriers, and long investment horizons. Private equity involves investing directly in companies, often taking a controlling stake and actively working to improve their operations and profitability. Venture capital focuses on funding startups and early-stage businesses with high growth potential, typically in technology, healthcare, or other innovative sectors. Both forms of investment require substantial capital, expertise, and a willingness to lock up funds for years, if not decades. The appeal of private equity and venture capital lies in the ability to generate outsized returns through business growth, strategic improvements, or eventual public listings. However, the risks are equally substantial. Many startups fail and private companies can face liquidity challenges, making it difficult to exit investments. For most individual investors, direct access to private equity and venture capital is limited, as these opportunities are usually reserved for institutional investors or high-net-worth individuals. However, some avenues such as crowdfunding platforms, private equity ETFs, or specialty funds offer indirect exposure. While these investments should only represent a small portion of a diversified portfolio, they can provide unique growth opportunities for those willing to accept the inherent risks. 6.5 Commodities. Investing in raw materials and natural resources. Commodities such as oil, natural gas, agricultural products, and metals represent another alternative asset class that can provide diversification and protection against inflation. These raw materials are essential to the global economy, and their prices are influenced by supply and demand dynamics, geopolitical events, and economic cycles. Investing in commodities can be done directly through futures contracts, which involve speculating on the price movements of specific commodities, or indirectly through ETFs, mutual funds, and stocks of companies involved in the production, refining, or distribution of these resources. Commodities often perform well during periods of inflation, as rising raw material prices can drive up the costs of goods and services. However, commodities are notoriously volatile and can be affected by factors beyond investor control, such as weather events, political instability, and changes in global trade policies. While they offer a hedge against certain economic risks, commodities should be approached with caution and as part of a broader, diversified investment strategy. For FIRE investors, commodities can act as a counterbalance to traditional assets, providing exposure to economic growth drivers and serving as an inflation hedge. Like other alternative investments, they should be used judiciously, with an understanding of the unique risks and market dynamics involved. 6.6 Collectibles and art. Investing in tangible, appreciating assets. Collectibles such as art, rare coins, vintage cars, and antiques offer a unique investment avenue that combines passion with the potential for financial gain. These tangible assets can appreciate significantly over time, driven by scarcity, historical significance, and aesthetic appeal. High-profile art auctions and record-breaking sales often make headlines, showcasing the allure of investing in rare and valuable items. Art and collectibles provide a form of wealth preservation, often independent of broader market movements. They also offer a personal connection to investments, allowing collectors to enjoy and display their assets while benefiting from potential appreciation. However, the market for collectibles is highly specialized, illiquid, and often subjective, with values influenced by trends, condition, and provenance. Investing in collectibles requires expertise, patience, and a deep understanding of the market. Authenticity, storage, and insurance are critical considerations, as well as the challenge of finding buyers when it's time to sell. For those with a passion for art or rare items, collectibles can offer both personal satisfaction and financial rewards, but they should not be relied upon as a primary investment vehicle. 6.7 Real estate investment trusts. REITs, a bridge between traditional and alternative. While real estate is often viewed as a traditional asset class, real estate investment trusts, REITs, occupy a unique space, blending elements of both traditional and alternative investments. REITs provide exposure to a wide range of real estate sectors, including commercial, industrial, residential, and specialized properties like data centers and healthcare facilities. REITs are particularly attractive because they offer liquidity, high dividend yields, and the opportunity to diversify within the real estate market without the need to manage properties directly. Unlike physical real estate, REIT shares can be bought and sold easily, providing flexibility and access to income-generating assets. REITs are required by law to distribute a significant portion of their income to shareholders, making them a popular choice for income-focused investors. However, they are still subject to market volatility, interest rate changes, and sector-specific risks. For FIRE investors, REITs can serve as an effective tool to enhance portfolio diversification, generate passive income, and gain exposure to real estate trends without the hands-on commitment of direct ownership. 6.8 Balancing alternative investments in your FIRE strategy. Incorporating alternative investments into your FIRE strategy can provide diversification, enhance returns, and reduce overall portfolio risk. However, it's crucial to strike the right balance, ensuring that these assets complement rather than dominate your core holdings. Alternative investments should enhance your portfolio's resilience, not introduce excessive complexity or risk. A thoughtful approach involves allocating a small percentage of your overall portfolio to alternative investments, guided by your risk tolerance, financial goals, and investment expertise. Conduct thorough research, seek professional advice if needed, and stay informed about the unique characteristics of each asset class. Remember that alternative investments often come with less liquidity, higher fees, and a need for active management, making them suitable for investors who are willing to invest time alongside money. As you build your FIRE portfolio, consider how alternative investments fit into your broader plan. They are not a replacement for stocks, bonds, or real estate but can play a valuable role in creating a well-rounded, diversified strategy that adapts to changing market conditions and personal circumstances. In the next chapter, we will explore the critical role of tax-advantaged accounts and tax optimization strategies in maximizing your investment returns. Taxes can be one of the biggest drags on your journey to financial independence, but with the right approach, you can keep more of your hard-earned money working for you. Let's continue to refine your investment strategy and take one step closer to achieving your financial goals with confidence and clarity. Chapter 7: Tax-Advantaged Accounts. Boosting Returns with Tax Efficiency. Taxes are often the invisible thief that quietly chips away at your hard-earned investment returns. While market volatility and inflation are commonly discussed risks, the drag caused by taxes can be just as damaging to your financial independence journey if not managed properly. The good news is that the tax code provides various opportunities to shield your investments from taxes, allowing you to grow your wealth more efficiently. For those pursuing FIRE, understanding and leveraging tax-advantaged accounts is crucial to maximizing your returns and reaching your goals faster. Tax-advantaged accounts, such as 401k, IRAs, Roth IRAs, and HSAs, are powerful tools that not only defer or eliminate taxes but also enhance the compounding effect of your investments. By reducing the tax burden on your portfolio, these accounts enable your money to work harder and compound faster over time. In this chapter, we'll explore the different types of tax-advantaged accounts, how to use them strategically, and additional tax optimization strategies that can significantly impact your financial independence journey. 7.1 Understanding the Basics. The Power of Tax-Deferred and Tax-Free Growth. Tax-advantaged accounts are designed to incentivize saving and investing for the future by offering tax benefits that are not available with regular brokerage accounts. These accounts can generally be classified into two categories: tax-deferred and tax-free. Tax-deferred accounts, such as traditional 401k, and IRAs, allow you to contribute pre-tax dollars, which means you don't pay taxes on the money you invest until you withdraw it in retirement. This setup lowers your taxable income in the year you make the contribution, providing an immediate tax break. The real power of tax-deferred accounts, however, lies in the compounding of pre-tax dollars. Because your investments grow without the drag of annual taxes on dividends, interest, and capital gains, your portfolio can accumulate much faster than in a taxable account. Tax-free accounts, like Roth IRAs and Roth 401k, work in the opposite way. You contribute after-tax dollars, meaning you don't get a tax deduction up front. However, the significant advantage is that your investments grow tax-free, and qualified withdrawals in retirement are also tax-free. This means that once your money is in a Roth account, it will never be taxed again, providing a powerful shelter for your long-term gains. Choosing between tax-deferred and tax-free accounts depends on your current tax situation and expectations about your tax rate in retirement. If you expect to be in a lower tax bracket in retirement, tax-deferred accounts may offer more benefits. Conversely, if you believe taxes will be higher in the future, or if you want the flexibility of tax-free withdrawals, Roth accounts can be particularly appealing. 7.2 Maximizing 401k contributions, a key step toward financial independence. The 401k is one of the most widely used tax-advantaged accounts, primarily offered by employers. It provides a significant opportunity for wealth accumulation due to high contribution limits and the potential for employer matching contributions. In 2024, the contribution limit for 401k plans is $22,500, with an additional $7,500 catch-up contribution allowed for those aged 50 and above. One of the most compelling aspects of the 401k is the employer match, which is essentially free money. Employers often match a percentage of your contributions, typically up to a certain limit, such as 3 to 5% of your salary. If you're not contributing enough to get the full match, you're leaving money on the table. It's one of the easiest ways to boost your retirement savings without any additional cost to you. Beyond the match, maxing out your 401k contributions can supercharge your savings. By contributing the maximum amount, you lower your taxable income significantly, and your investments enjoy years of tax-deferred growth. This is particularly advantageous for high-income earners who face steep tax rates, allowing them to reduce their tax bill while building their retirement nest egg. Strategically, 401k's are most effective when used consistently over time. Automatic contributions directly from your paycheck help maintain discipline, ensuring you save and invest regularly. This consistency, combined with the tax benefits, makes 401k's a cornerstone of any FIRE strategy. 7.3 Roth IRAs, the ultimate tax-free growth vehicle. The Roth IRA is often hailed as the holy grail of retirement accounts, especially for those pursuing early retirement. Unlike traditional IRAs, Roth IRAs are funded with after-tax dollars, and both your contributions and earnings grow tax-free. When you reach retirement age, you can withdraw your money without paying any taxes, which can be a massive advantage if tax rates rise in the future. Roth IRAs offer unparalleled flexibility, making them ideal for FIRE enthusiasts. Contributions, not earnings, can be withdrawn at any time without penalty, which provides a level of liquidity not found in other retirement accounts. This feature allows early retirees to access funds if needed, without incurring taxes or penalties, making Roth IRAs a valuable tool for bridging the gap between early retirement and traditional retirement age. One of the key benefits of the Roth IRA is the ability to engage in a Roth conversion ladder strategy. This involves converting portions of a traditional IRA or 401k into a Roth IRA over several years, paying taxes on the converted amount but allowing future growth to be tax-free. By carefully managing the timing and amount of conversions, you can minimize taxes and create a tax-free income stream for early retirement. However, Roth IRAs do come with contribution limits and income restrictions. For 2024, the contribution limit is $6,500, with a $1,000 catch-up for those aged 50 and older. Income limits also determine eligibility, so high earners may need to utilize a backdoor Roth IRA strategy, which involves contributing to a traditional IRA and then converting it to a Roth. This maneuver allows high-income individuals to circumvent the income restrictions and still benefit from Roth growth. 7.4 Health Savings Accounts, HSAs, triple tax advantage and a hidden gem. Health savings accounts, HSAs, are often overlooked but can be one of the most tax-efficient accounts available, offering what is known as a triple tax advantage. Contributions to HSAs are tax-deductible, the funds grow tax-free, and withdrawals are tax-free when used for qualified medical expenses. This combination of benefits makes HSAs an incredibly powerful tool, particularly for those with high-deductible health plans, HDHPs. HSAs can effectively double as retirement accounts if you are in good health and don't need to tap the funds for immediate medical expenses. Unlike flexible spending accounts, FSAs, HSA balances roll over from year to year, allowing you to invest the funds and let them grow over decades. Many financial experts recommend treating your HSA as a supplemental retirement account by investing the funds in mutual funds or ETFs rather than using them for current medical expenses. One of the lesser-known strategies with HSAs is the concept of paying out of pocket now and reimbursing yourself later. By paying current medical bills out of pocket and saving the receipts, you can withdraw HSA funds tax-free at any point in the future for those expenses. This effectively allows you to let your HSA investments grow untouched while still retaining the ability to access funds tax-free whenever needed. For FIRE enthusiasts, HSAs represent an underutilized opportunity to grow wealth while also preparing for healthcare costs in retirement. Given the rising cost of healthcare, having a dedicated tax-free account to cover these expenses can provide peace of mind and financial security. 7.5 The Mega Backdoor Roth, a powerful strategy for high earners. For those fortunate enough to have access to a 401k plan that allows after-tax contributions and in-service distributions, the Mega Backdoor Roth is an advanced strategy that can significantly boost retirement savings. This technique involves making after-tax contributions to your 401k, which can then be rolled over into a Roth IRA or Roth 401k, converting these after-tax dollars into tax-free growth. The allure of the Mega Backdoor Roth lies in its high contribution limits, allowing you to contribute well beyond the standard Roth IRA limits. For 2024, total 401k contributions, including employee contributions, employer matches, and after-tax contributions, can be up to $66,000. After maxing out your regular pre-tax or Roth contributions, any additional after-tax contributions can be funneled into your Roth account, unlocking potentially tens of thousands of dollars in additional tax-free savings each year. This strategy is complex and not available to everyone, as it requires specific 401k plan provisions. However, if available, it can be a game-changer for high earners looking to maximize their retirement savings while benefiting from the long-term advantages of tax-free growth. 7.6 Tax Loss Harvesting, turning losses into opportunities. Tax loss harvesting is a strategy used primarily in taxable accounts to reduce the amount of capital gains taxes owed. It involves selling investments that have declined in value to offset capital gains from other investments or to reduce ordinary taxable income. The losses generated can be used to offset up to $3,000 of ordinary income each year, and any additional losses can be carried forward to future years. This technique is especially beneficial in years when markets are down, allowing you to turn a negative market event into a tax-saving opportunity. The key is to reinvest the proceeds from the sale into a similar but not identical investment, maintaining your overall market exposure while capturing the tax benefit. While tax loss harvesting can effectively reduce your tax liability, it requires careful tracking and adherence to IRS rules, including the wash sale rule, which disallows claiming a loss on a security if a substantially identical one is purchased within 30 days before or after the sale. Many robo-advisors and financial planning tools now offer automated tax loss harvesting, making it easier for investors to take advantage of this strategy without the hassle of manual tracking. 7.7 Minimizing taxes on dividends and capital gains. Dividends and capital gains are essential components of investment income, but they also come with tax implications. Qualified dividends and long-term capital gains are generally taxed at lower rates than ordinary income, with rates ranging from 0% to 20%, depending on your income level. However, short-term capital gains, which apply to assets held for less than a year, are taxed at your ordinary income rate, which can be significantly higher. To minimize taxes on dividends and capital gains, prioritize holding income-generating assets in tax-advantaged accounts whenever possible. This shields your earnings from immediate taxation and allows them to compound without interruption. In taxable accounts, consider strategies such as holding investments for more than a year to qualify for lower long-term capital gains rates and choosing tax-efficient funds that minimize capital gain distributions. Tax-efficient investing also involves selecting funds with low turnover, as high turnover generates frequent taxable events. Index funds and ETFs typically have lower turnover compared to actively managed funds, making them a better choice for minimizing tax drag in taxable accounts. 7.8 Strategic Withdrawal Planning. Managing taxes in retirement. Effective tax management doesn't stop at accumulating wealth, it extends into how you withdraw your funds in retirement. Withdrawing strategically from different types of accounts, taxable, tax-deferred, and tax-free, can help you control your tax liability, maximize your income, and preserve your wealth over the long term. A common strategy is to withdraw first from taxable accounts, allowing tax-advantaged accounts to continue growing. Next, tap into tax-deferred accounts such as traditional IRAs and 401k(s), being mindful of required minimum distributions (RMDs) that begin at age 73. Finally, Roth accounts should be used last, as they offer tax-free withdrawals that can be valuable later in life when managing tax exposure becomes increasingly important. Roth conversions can also be strategically employed in early retirement years, particularly if your income is low and you're in a lower tax bracket. Converting portions of your traditional IRA or 401k to a Roth IRA during these years allows you to pay taxes at a lower rate while securing future tax-free withdrawals. 7.9 The role of professional advice. Navigating complex tax strategies. While understanding tax-advantaged accounts and basic tax strategies can significantly enhance your FIRE journey, tax planning can become complex, especially as your wealth grows. Engaging a certified financial planner or tax advisor can provide tailored advice that aligns with your specific goals, income, and investment profile. Professional guidance can help you navigate advanced strategies like Roth conversions, tax loss harvesting, and charitable giving, ensuring you optimize every aspect of your financial plan. The right advice can make a substantial difference in your overall tax efficiency, helping you keep more of your money working for you and reducing the risk of costly mistakes. As your financial situation evolves, periodic reviews with a professional can keep your plan on track and adjust your strategy to take advantage of new tax laws, regulations, and opportunities. 7.10 Integrating tax efficiency into your FIRE strategy. Tax efficiency is not just a peripheral consideration, it's a fundamental element of a successful FIRE strategy. By understanding how to leverage tax-advantaged accounts, minimize tax drag, and strategically manage withdrawals, you can significantly enhance your investment returns and accelerate your path to financial independence. Incorporating tax planning into your overall FIRE strategy allows you to keep more of what you earn, boosting the compounding effect and preserving your wealth for the long term. Remember, it's not just about how much you make, it's about how much you keep. With the right tax strategies in place, you can confidently build a sustainable financial future that supports your goals, lifestyle, and the freedom that FIRE represents. As we continue, the next chapter will guide you through the critical task of managing your portfolio, keeping it balanced, rebalancing as necessary, and staying aligned with your risk tolerance and financial goals. Let's keep moving forward, refining your approach, and empowering you to make the most of every dollar you invest. Chapter 8. Managing your portfolio, rebalancing and staying on track. Building a successful investment portfolio is not a one-time event. It's an ongoing process that requires attention, discipline, and strategic adjustments. Managing your portfolio effectively is crucial to maintaining alignment with your financial goals, risk tolerance, and time horizon, especially as you progress along your journey to financial independence. While choosing the right investments is essential, equally important is knowing how to monitor, adjust, and optimize your portfolio over time. A well-managed portfolio doesn't just grow, it evolves. Market conditions change, personal circumstances shift, and what once was the ideal mix of assets may no longer serve your best interests. Rebalancing, risk management, and strategic adjustments help keep your portfolio on track, ensuring that it continues to work hard toward your FIRE goals. This chapter delves deep into the principles of effective portfolio management, the importance of rebalancing, and how to stay disciplined and focused on your path to financial independence. 8.1 The foundation of portfolio management. Setting clear objectives. The first step in managing any portfolio is setting clear and measurable objectives. Your portfolio is not just a collection of investments, it's a strategic tool designed to achieve specific financial goals. Whether your aim is to retire early, generate passive income, or build wealth for future generations, every decision you make should reflect these objectives. A key component of setting objectives is understanding your risk tolerance and time horizon. Risk tolerance refers to how much volatility you are comfortable with in your investments, while time horizon refers to the length of time you expect to hold your investments before needing to access them. Younger investors with a longer time horizon can typically afford to take on more risk, as they have time to recover from market downturns. Conversely, those nearing retirement may prioritize preserving capital and generating steady income. To set effective objectives, consider the following questions. What is your desired level of return? How much risk are you willing to take to achieve it? How often will you review and adjust your portfolio? Your answers will form the foundation of your investment strategy, guiding you in the selection of assets and informing your approach to portfolio management. 8.2 Asset allocation. The key to balancing risk and reward. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, real estate, and alternative investments, in a way that aligns with your risk tolerance, goals, and time horizon. It's one of the most critical decisions you'll make as an investor, as it directly impacts your portfolio's overall performance and risk profile. The primary goal of asset allocation is to achieve diversification, which helps reduce risk by spreading your investments across various asset types. Diversification ensures that no single investment or asset class has an outsized impact on your overall portfolio, protecting you from the full brunt of market volatility. For example, when stocks experience a downturn, bonds or real estate investments might provide stability, cushioning your overall losses. There are several common asset allocation models, ranging from conservative, heavy in bonds and cash, to aggressive, heavy in stocks and alternative investments. For those pursuing FIRE, a balanced approach that emphasizes growth while managing risk is often ideal. A typical FIRE portfolio might allocate 70 to 90% to stocks and 10 to 30% to bonds or other fixed income assets, adjusting as you approach your target retirement date. As your financial situation and market conditions evolve, your asset allocation should be periodically reviewed and adjusted to ensure it remains aligned with your objectives. Sticking to a predetermined asset allocation strategy helps you stay disciplined, avoiding the temptation to chase trends or react impulsively to short-term market movements. 8.3 The art of rebalancing. Maintaining your target allocation. Rebalancing is the practice of realigning your portfolio to maintain your target asset allocation. Over time, market movements can cause your portfolio to drift from its original allocation, exposing you to more risk than you intended. For example, during a prolonged bull market, your stock holdings may grow significantly, while your bond holdings lag behind, resulting in a portfolio that is overly weighted toward equities and thus more vulnerable to a market correction. Rebalancing involves selling some of your overperforming assets and buying more of your underperforming ones to bring your portfolio back in line with your desired allocation. This disciplined approach not only keeps your risk in check but also encourages you to buy low and sell high, as you trim gains from appreciated assets and invest in those that are temporarily out of favor. There are several approaches to rebalancing, each with its own merits. 1. Calendar-based rebalancing. Rebalance your portfolio on a set schedule, such as annually or semi-annually. This method is straightforward and ensures that you don't go too long without adjusting your asset mix, but it may result in rebalancing during inopportune market conditions. 2. Threshold-based rebalancing. Rebalance only when your portfolio deviates from its target allocation by a certain percentage, such as 5% or 10%. This approach is more flexible and allows you to rebalance when market conditions warrant it, rather than on a fixed schedule. 3. Combination approach. Use a combination of calendar-based and threshold-based rebalancing, checking your portfolio periodically and rebalancing only if it has drifted beyond a specified threshold. The key to successful rebalancing is consistency. By regularly reviewing your portfolio and making necessary adjustments, you can maintain the appropriate level of risk and ensure that your investments remain aligned with your long-term goals. 8.4 Staying the course. Managing emotions in a volatile market. One of the greatest challenges in managing a portfolio is maintaining discipline during periods of market volatility. Human emotions, particularly fear and greed, can drive impulsive decisions that undermine your investment strategy. When markets are soaring, it's tempting to chase the hottest stocks or sectors, often at inflated prices. Conversely, during downturns, the instinct to sell and cut your losses can lead to panic selling, locking in losses and missing out on potential recoveries. Staying the course requires a clear understanding of your investment plan and a commitment to your long-term objectives. Remind yourself that market fluctuations are a normal part of investing, and that temporary declines are not necessarily indicative of permanent loss. Historically, markets have rebounded from downturns, rewarding those who maintain a steady, disciplined approach. One effective way to manage emotions is through the use of investment policy statements, IPS. An IPS is a written document that outlines your investment strategy, including your objectives, risk tolerance, target asset allocation, and rules for rebalancing. By having a formal plan in place, you create a guidepost that helps you make rational decisions, even when emotions are running high. Regularly reviewing your IPS, particularly during periods of market stress, can reinforce your commitment to your strategy and remind you of the long-term nature of your goals. When you feel the urge to make impulsive changes, refer back to your IPS to ensure that any adjustments are consistent with your overall plan. 8.5 Monitoring performance. Are you on track? Effective portfolio management involves ongoing monitoring of your investments to ensure that you're on track to meet your financial goals. This doesn't mean obsessing over daily price movements, but rather conducting periodic reviews to assess performance, identify areas for improvement, and make informed adjustments. When evaluating your portfolio's performance, focus on the overall progress toward your objectives rather than the performance of individual investments. Are you achieving the returns needed to meet your FIRE goals? Is your portfolio growing at a rate that aligns with your target retirement date? These are the questions that matter most, rather than whether a particular stock outperformed or underperformed in a given quarter. It's also important to benchmark your performance against appropriate indices. If your portfolio is primarily composed of U.S. stocks, compare its performance to a broad market index like the S&P 500. For bonds, use a relevant bond index. This allows you to measure how well your portfolio is performing relative to the broader market and helps identify whether your investment strategy is delivering the expected results. Monitoring your portfolio also involves keeping an eye on the fundamentals of your individual investments. For stocks, this means staying updated on earnings reports, management changes, and industry trends. For real estate, it involves tracking rental income, property values, and market conditions. Staying informed ensures that your portfolio remains resilient and well-positioned to capitalize on opportunities. 8.6 Adapting to life changes. When and how to adjust your portfolio. Life is dynamic, and your financial plan must adapt to reflect changes in your circumstances. Major life events, such as getting married, having children, changing jobs, or experiencing a windfall, can impact your financial goals, risk tolerance, and investment needs. When such changes occur, it's essential to revisit your portfolio and make necessary adjustments. For example, a significant increase in income might enable you to increase your investment contributions, accelerating your path to financial independence. Conversely, a job loss or unexpected expense might require you to temporarily reduce contributions or adjust your asset allocation to prioritize liquidity. The key is to remain flexible and proactive. Regularly review your financial plan and portfolio to ensure that they continue to align with your current circumstances. Don't be afraid to make changes when warranted, but ensure that these adjustments are guided by thoughtful consideration rather than reactive emotions. 8.7 Risk management. Protecting your portfolio from the unexpected. Managing a portfolio is not just about maximizing returns, it's also about managing risk. Effective risk management involves protecting your investments from unforeseen events that could derail your financial plan, such as market crashes, economic recessions, or personal emergencies. One way to manage risk is through diversification, spreading your investments across different asset classes, sectors, and geographic regions. Diversification reduces the impact of any single investment or market event on your overall portfolio, providing a buffer against losses. Another critical aspect of risk management is maintaining an adequate emergency fund. While not part of your investment portfolio, an emergency fund acts as a financial safety net, covering unexpected expenses without forcing you to liquidate investments at inopportune times. A good rule of thumb is to keep 3 to 6 months of living expenses in a readily accessible savings account. Insurance is another tool for managing risk. Health insurance, disability insurance, and life insurance can provide financial protection in the event of illness, injury, or death, safeguarding your portfolio from the need to cover substantial out-of-pocket costs. Long-term care insurance can also be valuable for older individuals, helping to cover the costs of care in the event of chronic illness or disability. 8.8 Staying informed. Continuing education as part of portfolio management. The financial world is constantly evolving with new investment opportunities, economic developments, and regulatory changes emerging regularly. Staying informed is an essential part of managing your portfolio and ensuring that your strategy remains relevant and effective. Continuing education can take many forms, from reading investment books and following financial news to taking courses on specific investment topics or seeking advice from financial professionals. Podcasts, webinars, and online forums also offer valuable insights from experienced investors and experts. An educated investor is a confident investor. By deepening your knowledge, you empower yourself to make informed decisions, adapt to market changes, and capitalize on new opportunities. This commitment to ongoing learning is particularly important for those on the FIRE path, as the strategies that work best today may need to be adjusted as you move closer to your financial independence goals. 8.9 Automating your investment process. Streamlining portfolio management. Automation is a powerful tool that can simplify the process of managing your portfolio, ensuring consistency and discipline without the need for constant oversight. Automatic contributions, automatic rebalancing, and automatic reinvestment of dividends are all strategies that help keep your portfolio on track with minimal effort. Many brokerages and robo-advisors offer automated services that handle these tasks for you, allowing you to focus on your broader financial plan rather than the day-to-day management of your investments. Automation reduces the likelihood of emotional decision-making and ensures that your portfolio remains aligned with your objectives, even when life gets busy. Automating your investment process doesn't mean setting it and forgetting it entirely. Regular check-ins are still important, but automation frees up time and mental energy, allowing you to enjoy the journey to financial independence without the constant burden of portfolio management. 8.10 The Path Forward. Staying aligned with your FIRE goals. Portfolio management is a dynamic, ongoing process that requires attention, discipline, and strategic thinking. By setting clear objectives, maintaining your target asset allocation, rebalancing regularly, and staying informed, you can effectively manage your investments and keep them aligned with your financial independence goals. Remember that the journey to FIRE is not just about accumulating wealth, it's about managing that wealth wisely to support the life you want to live. Every decision you make, from rebalancing to adjusting your risk profile, should reflect your commitment to achieving financial freedom. Stay disciplined, stay focused, and keep moving forward with confidence. In the next chapter, we will explore how to deal with market volatility, the importance of a long-term mindset, and strategies to remain calm and collected during turbulent times. Investing is a marathon, not a sprint, and learning how to navigate the emotional ups and downs of the market is critical to staying the course. Let's continue to build the skills and knowledge that will guide you to a secure and fulfilling financial future. Chapter 9, Dealing with Market Volatility, Staying Calm in a Storm. Market volatility is an inescapable part of investing. While the stock market has historically trended upward over the long term, the journey is often marked by periods of turbulence, sharp declines, and moments of sheer uncertainty. For many investors, these fluctuations can be unnerving, prompting emotional responses that lead to impulsive decisions, such as panic selling during downturns or chasing high-flying stocks during bubbles. However, volatility isn't necessarily a bad thing. It's a natural component of the market's dynamics and, when properly managed, can even present valuable opportunities. Understanding how to navigate market volatility, maintain composure, and stick to your investment strategy is crucial to achieving financial independence. This chapter will delve into the psychology of market volatility, the importance of a long-term perspective, and practical strategies for managing your investments during volatile periods without losing sight of your FIRE goals. 9.1 The nature of market volatility, understanding the ups and downs. Market volatility refers to the frequency and magnitude of price swings in financial markets. These swings can be driven by various factors, including economic data, corporate earnings reports, geopolitical events, interest rate changes, and investor sentiment. While market movements can feel random and unpredictable in the short term, they are often part of broader cycles influenced by fundamental factors. In periods of high volatility, stock prices can fluctuate dramatically within a short span, often leaving investors feeling uncertain about the future. During a bull market, prices rise steadily, often fueled by optimism, strong economic growth, and increasing corporate profits. However, when conditions shift, such as during a recession, political turmoil, or a sudden market shock, the mood can change rapidly, triggering sell-offs and sharp declines. It's important to recognize that volatility is not synonymous with risk. Risk, in investment terms, refers to the possibility of permanent loss of capital, whereas volatility represents temporary price fluctuations. While volatility can feel uncomfortable, especially during severe market corrections, it does not necessarily equate to a loss unless you choose to sell during the downturn. In many cases, the market recovers and long-term investors are rewarded for their patience. 9.2 The psychology of investing. Managing fear and greed. Investing is as much an emotional journey as it is a financial one. Human psychology plays a significant role in how investors respond to market volatility, often leading to behavior that can undermine long-term success. Two primary emotions, fear and greed, tend to dominate decision-making during volatile times. Fear is the most powerful emotion in the market, often leading investors to sell their holdings during downturns in an attempt to avoid further losses. This response, known as panic selling, can be highly detrimental, as it locks in losses and prevents investors from benefiting from future recoveries. Fear-driven selling typically peaks during bear markets, when pessimism is at its highest and prices are at their lowest. Greed, on the other hand, can drive investors to take excessive risks, chase high returns, or invest in speculative assets without proper analysis. During bull markets, greed often leads to fear of missing out, FOMO, causing investors to buy into overvalued stocks or sectors at the height of their popularity, only to suffer when the bubble bursts. Managing these emotions requires self-awareness, discipline, and a strong commitment to your investment strategy. Recognize that emotional responses are natural, but they should not dictate your investment decisions. Instead, rely on rational analysis, long-term planning, and the principles of sound investing to guide your actions. 9.3 The importance of a long-term perspective. Time is your greatest ally. One of the most effective ways to combat market volatility is to adopt a long-term perspective. When viewed over days, weeks, or even months, market movements can appear erratic and unpredictable. However, when stretched over years and decades, the stock market's trajectory has historically been upward, driven by economic growth, innovation, and corporate profitability. Investors who remain committed to their long-term plans and resist the urge to react to short-term fluctuations are often the ones who achieve the best outcomes. The most powerful tool at your disposal is time. By staying invested, you give your portfolio the opportunity to recover from downturns and capture the growth that follows. Consider the historical performance of the S&P 500, one of the most widely followed stock market indices. Despite numerous market crashes, recessions, and geopolitical crises, the S&P 500 has consistently rebounded and reached new highs over time. Investors who remained invested during the Great Recession of 2008, the dot-com bubble of the early 2000s, or the COVID-19 market crash of 2020 ultimately saw their portfolios recover and grow. Those who sold out of fear, however, often missed out on the market's subsequent gains. A long-term perspective not only helps you weather volatility but also aligns with the principles of compounding, allowing your investments to grow exponentially. The key is to stay focused on your goals, tune out the noise of daily market headlines, and remember that investing is a marathon, not a sprint. 9.4 Strategies for staying calm during market turbulence. While understanding volatility is important, having actionable strategies to manage it is essential. Here are some practical approaches to help you stay calm and keep your investment strategy on track during turbulent times. 1. Stick to your plan. Your investment plan is your roadmap to financial independence. It was designed with your goals, risk tolerance, and time horizon in mind. During volatile periods, refer back to your plan and remind yourself why you chose your specific asset allocation and investment strategy. Revisit your long-term goals and reaffirm your commitment to your investment approach. 2. Automate your investments. Automating your investment contributions can help remove the emotional aspect of investing. When contributions are automatic, you are less likely to second-guess your decisions based on market movements. Dollar-cost averaging, where you invest a fixed amount at regular intervals, ensures that you continue to buy investments regardless of market conditions, smoothing out the impact of volatility. 3. Rebalance your portfolio. Regular rebalancing can help maintain your desired level of risk and take advantage of market volatility. During downturns, rebalancing may involve selling bonds or other stable assets to buy more stocks at lower prices, positioning your portfolio to benefit when the market recovers. Rebalancing enforces discipline, allowing you to stay aligned with your target allocation and avoid emotionally driven shifts in your asset mix. 4. Focus on fundamentals, not headlines. The media often amplifies market volatility with sensational headlines that can heighten emotions and fuel irrational behavior. Rather than reacting to news, focus on the fundamentals of your investments. Are the companies you own still performing well? Are the underlying economic conditions supportive of long-term growth? Keeping your attention on the fundamentals helps you maintain a rational perspective. 5. Maintain a cash cushion. Having an emergency fund or a small cash reserve in your portfolio can provide peace of mind during volatile periods. This buffer allows you to avoid selling investments at a loss to cover unexpected expenses, providing a financial safety net that supports your overall strategy. 6. Stay educated and informed. Knowledge is power when it comes to investing. Continuously educating yourself about market dynamics, investment principles, and financial history can help you build confidence in your strategy. Understanding that market corrections and bear markets are a natural part of the investment cycle can make them feel less threatening and easier to navigate. 7. Seek professional guidance. If market volatility leaves you feeling uncertain or overwhelmed, consider consulting a financial advisor. A professional can provide objective advice, help you stay on track, and adjust your strategy as needed. They can also offer reassurance during market downturns, reminding you of your long-term plan and helping you avoid costly mistakes. 9.5 Turning volatility into opportunity. The case for contrarian investing. While volatility can be unsettling, it also presents opportunities for investors who are willing to think differently and act against the crowd. Contrarian investing involves buying assets that are out of favor, often during periods of extreme pessimism, when prices are low relative to their intrinsic value. This approach requires courage, patience, and a deep understanding of market dynamics, but it can yield significant rewards. The most successful contrarian investors are those who can look beyond short-term noise and recognize value where others see only risk. During market sell-offs, high-quality stocks may become undervalued, presenting a buying opportunity for investors who believe in the company's long-term prospects. Similarly, sectors that are temporarily out of favor, such as energy, technology, or financials, can offer attractive entry points when broader market sentiment is negative. Contrarian investing is not about trying to time the market perfectly. Rather, it's about being disciplined and having the conviction to buy when others are fearful. This strategy is rooted in the principle that markets tend to overreact in both directions, creating opportunities for those who can maintain a steady hand. 9.6 The power of patience. Letting time work for you. Patience is one of the most underrated but powerful traits in investing. The ability to stay invested through market ups and downs, maintain composure during downturns, and resist the urge to chase short-term gains can make all the difference in your long-term success. Remember, the stock market rewards patience, not perfection. Historical data consistently shows that investors who remain patient and stick to their investment strategy outperform those who frequently buy and sell in response to market volatility. Attempting to time the market, selling at the top and buying at the bottom, is nearly impossible even for professional investors. More often than not, those who try to time the market miss out on the best days, which can significantly impact long-term returns. Instead of focusing on timing, focus on time in the market. Stay invested, stay disciplined, and let the compounding effect work in your favor. Remember that market downturns, while challenging, are often followed by periods of robust recovery. The greatest risk is not volatility itself, but the temptation to abandon your plan during turbulent times. 9.7 Building resilience. Preparing your portfolio for volatility. Building a resilient portfolio involves more than just selecting the right investments. It's about creating a strategy that can weather different market environments. Diversification, asset allocation, and rebalancing are all essential components of a resilient portfolio, helping you manage risk and maintain stability even when markets are rocky. Stress testing your portfolio, evaluating how it might perform in different market scenarios, can also provide valuable insights. Consider how your investments would hold up during a recession, a market crash, or a period of rising interest rates. By understanding potential vulnerabilities, you can make proactive adjustments, such as increasing your allocation to defensive sectors, adding bonds, or maintaining a cash reserve. Resilience also extends to your mindset. Cultivating a sense of perspective, focusing on your long-term goals, and reminding yourself of the historical resilience of markets can help you stay calm and collected during periods of volatility. Investing is a journey, and maintaining resilience, both in your portfolio and in your outlook, is key to reaching your financial independence goals. 9.8 The role of diversification in managing volatility. Diversification is often referred to as the only free lunch in investing. By spreading your investments across a wide range of asset classes, sectors, and geographies, you reduce the impact of any single investment's poor performance on your overall portfolio. Diversification doesn't eliminate volatility, but it does help smooth out returns, making the ups and downs more manageable. A diversified portfolio might include U.S. and international stocks, bonds, real estate, and alternative investments like commodities or precious metals. Each of these asset classes behaves differently under various market conditions, providing balance and reducing overall risk. For example, when stocks decline, bonds may hold steady or even gain in value, offsetting losses and providing stability. Rebalancing your diversified portfolio regularly ensures that you maintain the desired mix of assets, capturing gains from outperforming investments and reinvesting in underperforming ones. This disciplined approach helps you stay aligned with your risk tolerance and long-term strategy, making it easier to navigate volatile markets with confidence. 9.9 Staying true to your strategy, avoiding common pitfalls. The biggest mistakes investors make during volatile markets often stem from abandoning their strategy in favor of short-term, emotionally driven actions. Common pitfalls include panic selling, chasing hot stocks, or attempting to time the market based on headlines. These behaviors not only increase transaction costs and tax liabilities but also disrupt the compounding process, undermining your long-term success. Staying true to your strategy means trusting the plan you've built and avoiding the temptation to deviate when markets get choppy. Focus on your long-term objectives, adhere to your rebalancing schedule, and resist the urge to react to every market movement. The best investors are those who can keep a cool head, stay disciplined, and maintain a steady course, even in the face of uncertainty. 9.10 Looking ahead. Volatility is part of the journey. Volatility is an inevitable part of investing, but it doesn't have to be an obstacle to achieving financial independence. By understanding the nature of market swings, managing your emotions, and employing strategies that keep you on track, you can turn volatility into an opportunity rather than a threat. Embrace the ups and downs as part of the journey, knowing that your commitment to a long-term strategy, disciplined rebalancing, and a diversified portfolio will guide you through. Investing is not about avoiding risk altogether. It's about managing it wisely, staying the course, and letting time work its magic. As we move into the final chapter, we'll explore how to build a sustainable withdrawal strategy for early retirement, turning your hard-earned investments into a reliable income stream that supports your desired lifestyle. Let's continue to build your financial knowledge and take the next steps toward living the life you've envisioned through the power of smart investing. Chapter 10: Building a Sustainable Withdrawal Strategy for Early Retirement. Reaching financial independence is an incredible achievement, but the journey doesn't end when you decide to retire early, it merely enters a new phase. Once you have built your wealth and reached your FIRE number, the next critical task is to develop a sustainable withdrawal strategy that allows you to live off your investments without outliving your money. The shift from accumulation to withdrawal requires careful planning, strategic adjustments, and a clear understanding of how to turn your portfolio into a dependable income stream that will support your desired lifestyle for decades to come. Unlike traditional retirees who often have pensions or Social Security to rely on, early retirees must be more self-reliant, drawing from their investments to cover their expenses. This chapter will guide you through the complexities of creating a sustainable withdrawal strategy, exploring the 4% rule, various withdrawal methods, tax-efficient strategies, and how to manage your portfolio during retirement. With thoughtful planning, you can enjoy a fulfilling, financially secure retirement without the fear of running out of money. 10.1 The 4% Rule. A starting point, not a one-size-fits-all solution. The 4% rule is one of the most widely known guidelines for retirement withdrawals. It was popularized by the Trinity study, which analyzed historical market data to determine how much a retiree could safely withdraw from their portfolio each year without depleting their savings over a 30-year period. According to the study, withdrawing 4% of your initial portfolio value, adjusted annually for inflation, provided a high likelihood of your money lasting for the duration of retirement. For example, if you retire with a portfolio of $1 million, the 4% rule suggests you could withdraw $40,000 in your first year of retirement. In subsequent years, you would adjust that amount for inflation, maintaining your purchasing power as the cost of living rises. The simplicity of the 4% rule makes it an attractive starting point for many FIRE enthusiasts, offering a clear and straightforward approach to determining your initial withdrawal rate. However, the 4% rule is not without its limitations. It is based on historical data and assumes a balanced portfolio of stocks and bonds, as well as a traditional 30-year retirement horizon. Early retirees who may need their savings to last 40 or 50 years face a different set of challenges. Market conditions, inflation rates, and personal spending needs can vary significantly from the historical averages on which the rule is based, making it crucial to view the 4% rule as a guideline rather than a hard and fast rule. To account for these variables, consider adopting a more flexible approach to withdrawals, adjusting your spending based on market performance, and maintaining a cushion in your budget to absorb unexpected expenses. The goal is to create a dynamic withdrawal strategy that adapts to changing circumstances, ensuring your money lasts throughout your retirement. 10.2 Variable Withdrawal Strategies. Adapting to market conditions. A sustainable withdrawal strategy requires flexibility. Rigidly sticking to a fixed percentage withdrawal, regardless of market performance, can put undue pressure on your portfolio during downturns and may increase the risk of running out of money. Variable withdrawal strategies, which adjust your withdrawals based on market conditions or portfolio performance, can provide a more resilient approach. Guardrail strategy. One popular variable method is the guardrail strategy, which sets upper and lower bounds for your withdrawals based on your portfolio's value. If your portfolio performs well, you can increase your withdrawals within predefined limits, enjoying a higher standard of living. Conversely, if your portfolio declines, you reduce withdrawals temporarily to preserve your capital. This strategy acts like a shock absorber for your retirement plan, smoothing out the impact of market volatility. For example, you might set your guardrails at 10% above and below your initial withdrawal rate. If your portfolio grows significantly, you could increase your withdrawal to 4.4%. If it drops, you might reduce it to 3.6%. By making these adjustments, you can maintain financial stability even during challenging market environments. Dynamic spending rules. Another approach is to base your withdrawals on a percentage of your current portfolio value rather than a fixed dollar amount. For instance, you could decide to withdraw 3 to 5% of your portfolio each year, adjusting your spending based on how your investments are performing. This method provides greater flexibility and reduces the risk of depleting your funds too quickly during market downturns. While dynamic spending rules require more discipline and adaptability, they offer a significant advantage. They align your withdrawals with your portfolio's health, ensuring you live within your means and safeguard your financial future. 10.3 Bucket Strategy: Structuring your portfolio for income and stability. The bucket strategy is a popular method for managing withdrawals, designed to balance the need for short-term cash flow with the goal of long-term growth. This approach divides your portfolio into separate buckets, each serving a distinct purpose and time horizon. Typically, the buckets are structured as follows. Bucket 1: Cash and short-term reserves. This bucket holds enough cash and low-risk investments to cover your expenses for the next 1 to 3 years. The purpose of this bucket is to provide liquidity and protect against having to sell investments during a market downturn. By keeping your short-term needs separate from your growth assets, you reduce the stress of market volatility and ensure you have reliable access to funds. Bucket 2: Intermediate-term investments. The second bucket consists of bonds, dividend-paying stocks, and other income-generating assets designed to provide stability and moderate growth over a 3 to 10-year horizon. This bucket is intended to replenish your short-term reserves as needed, while still offering a buffer against market fluctuations. Bucket 3: Long-term growth. The third bucket is dedicated to long-term growth and includes higher-risk investments such as stocks and real estate. This bucket is not intended to be touched for 10+ years, allowing it to compound and generate the returns necessary to sustain your retirement over the long haul. During good market years, you can sell a portion of these assets to replenish the other buckets, keeping your withdrawal strategy intact. The bucket strategy provides a clear framework for managing withdrawals, helping you stay calm during market downturns by ensuring that you're not forced to sell long-term investments at a loss. It also creates a psychological benefit by organizing your assets according to your spending needs, allowing you to see a clear path to meeting your financial goals. 10.4 Tax-efficient withdrawals. Keeping more of your money. Taxes can significantly impact your retirement income, reducing the amount you have available to spend. Developing a tax-efficient withdrawal strategy is essential to maximize the longevity of your portfolio. This involves carefully coordinating withdrawals from taxable, tax-deferred, and tax-free accounts to minimize your overall tax burden. Order of withdrawals. A common tax-efficient strategy is to withdraw first from taxable accounts, allowing tax-advantaged accounts to continue growing. Next, tap into tax-deferred accounts such as traditional IRAs and 401(k)s, being mindful of required minimum distributions (RMDs) that begin at age 73. Finally, draw from Roth accounts, which offer tax-free withdrawals and can be a valuable resource later in retirement when tax rates may be higher. Roth conversions. For early retirees, Roth conversions can play a critical role in managing taxes. By converting portions of your traditional IRA or 401(k) to a Roth IRA during years when your income is low, you pay taxes at a potentially lower rate, securing tax-free growth and withdrawals for the future. Conversions can be spread out over several years to avoid pushing yourself into higher tax brackets, and they provide flexibility in creating a tax-efficient income stream. Tax loss harvesting. If you hold investments in taxable accounts, tax loss harvesting can help offset capital gains, reducing your taxable income. By strategically selling investments that have declined in value, you can capture losses that can be used to offset gains from other investments or up to $3,000 of ordinary income per year. This strategy provides additional tax savings, enhancing your overall withdrawal plan. Careful tax planning throughout retirement can make a substantial difference in how long your money lasts. By managing your withdrawals with a tax-efficient mindset, you keep more of your money working for you, extending the life of your portfolio and supporting a more comfortable retirement. 10.5 Managing sequence of returns risk. Protecting your portfolio in the early years. One of the biggest challenges for early retirees is sequence of returns risk. The danger that poor market performance in the early years of retirement can deplete your portfolio faster than expected. When withdrawals coincide with market declines, the impact on your savings can be severe, as you are forced to sell investments at depressed prices, leaving less capital to recover when the market rebounds. To mitigate sequence of returns risk, it's crucial to adopt a withdrawal strategy that protects your portfolio during the early years. Here are some key approaches. 1. Start conservatively. In the first few years of retirement, Consider withdrawing a smaller percentage of your portfolio, such as 3 to 3.5%, instead of the full 4%. This conservative approach allows your investments more time to grow and recover from any early losses. 2. Use a cash buffer. Having a cash buffer, as seen in the bucket strategy, can help you avoid selling investments during market downturns. By drawing from your cash reserves during difficult market periods, you preserve your long-term investments and give them time to recover. 3. Flexible spending. Be willing to adjust your spending based on market performance. If your portfolio experiences a significant decline, temporarily reducing discretionary spending can help preserve your capital. Conversely, if the market performs well, you can enjoy a higher withdrawal rate. 4. Delay major purchases. Postpone any large discretionary expenses such as home renovations or travel during periods of poor market performance. Waiting until your portfolio is healthier to make big purchases can prevent unnecessary strain on your retirement funds. Managing sequence of returns risk is about being proactive and adaptable, recognizing that the early years of retirement are critical to your long-term success. By protecting your portfolio during these vulnerable years, you can create a more resilient and sustainable withdrawal strategy. 10.6 Income diversification. Creating multiple streams of retirement income. Relying solely on portfolio withdrawals can be stressful, particularly during periods of market volatility. To reduce this pressure, consider diversifying your income sources in retirement. Multiple streams of income provide stability, reduce reliance on any one asset, and create a financial cushion that supports your overall plan. Rental income. Real estate investments can generate steady cash flow through rental income, providing a reliable source of funds that isn't directly tied to the stock market. Rental properties, REITs, or even short-term vacation rentals can add a valuable income stream that supports your withdrawal strategy. Dividend income. Investing in dividend-paying stocks or funds offers another source of income that can help meet your living expenses without the need to sell assets. Dividends provide cash flow while allowing your investments to continue growing, creating a dual benefit of income and capital appreciation. Part-time work or passion projects. For many early retirees, part-time work, consulting, or monetizing a hobby can supplement their income and provide a sense of purpose. This additional income can help buffer your portfolio during lean years and allow you to delay larger withdrawals, preserving your nest egg. Annuities. For those seeking a guaranteed income stream, annuities can provide a level of financial security by offering regular payments in exchange for an upfront investment. While not for everyone, annuities can be a useful tool for risk-averse retirees looking to supplement their withdrawal strategy with predictable income. Diversifying your income sources reduces the strain on your portfolio and adds a layer of resilience to your retirement plan. By combining different income streams, you can create a more stable and sustainable financial foundation that supports your desired lifestyle. 10.7 Healthcare planning. Navigating costs in early retirement. Healthcare is often one of the most significant expenses in retirement, particularly for those who retire before becoming eligible for Medicare at age 65. Navigating healthcare costs is a crucial aspect of any sustainable withdrawal strategy, as unexpected medical expenses can quickly deplete your savings. Health savings accounts, HSAs, as discussed in previous chapters. HSAs offer a triple tax advantage and can be an excellent tool for covering medical expenses in retirement. By investing in your HSA and allowing the funds to grow, you can create a dedicated account for healthcare costs, preserving your other retirement assets. COBRA and marketplace insurance. For those retiring before 65, health insurance through COBRA, a temporary extension of employer-provided coverage, or the health insurance marketplace can bridge the gap until Medicare eligibility. While premiums can be high, budgeting for these costs and exploring subsidies available through the marketplace can help manage expenses. Medicare and supplemental coverage. Once eligible for Medicare, carefully evaluate your coverage options, including Medicare Advantage plans and supplemental insurance, Medigap, to protect against out-of-pocket costs. Planning for long-term care either through insurance or dedicated savings is also critical to managing potential future healthcare needs. Healthcare planning requires foresight and proactive budgeting, ensuring that medical expenses do not derail your overall withdrawal strategy. By preparing for these costs, you can maintain financial stability and peace of mind throughout your retirement years. 10.8 Reviewing and adjusting your withdrawal plan. Staying on course. A sustainable withdrawal strategy is not static. It requires regular review and adjustments to stay on course. Periodically reassess your spending, portfolio performance, and life circumstances to ensure that your plan remains aligned with your goals. Life events, such as changes in health, unexpected expenses, or market shifts, may necessitate tweaks to your withdrawal strategy. Annual reviews provide an opportunity to evaluate whether your withdrawal rate is sustainable, adjust your spending as needed, and rebalance your portfolio to maintain your desired level of risk. Regular check-ins with a financial advisor can also provide valuable insights and help you navigate any challenges that arise. Staying flexible and open to adjustments keeps your withdrawal strategy resilient, allowing you to adapt to the evolving landscape of retirement. Remember, the goal is not just to maintain your wealth but to enjoy it, living the life you've worked so hard to create. 10.9 The emotional aspect of spending in retirement. Balancing enjoyment and prudence. The transition from saving to spending can be a psychological hurdle for many retirees. After years of diligently saving and investing, shifting to a mindset of drawing down your assets can feel unsettling, often leading to fears of spending too much or too soon. Balancing the enjoyment of your hard-earned wealth with the prudence of maintaining financial security requires mindful planning and a clear understanding of your goals. Recognize that your retirement savings are meant to support the life you've envisioned, and it's okay to spend within the framework of a well-structured plan. Be intentional with your spending, prioritizing experiences and activities that bring joy and fulfillment. At the same time, maintain a level of financial mindfulness, ensuring that your spending aligns with the long-term sustainability of your plan. Creating a budget or spending plan that reflects your values can help you strike the right balance. By categorizing expenses into essentials, discretionary items, and luxury splurges, you can make informed decisions about where to allocate your resources, ensuring that you enjoy your retirement without compromising your financial independence. 10.10 Living your FIRE dream. Embracing freedom and financial confidence. Achieving financial independence is about more than just numbers on a spreadsheet. It's about creating the life you want to live, free from financial stress and full of possibilities. A sustainable withdrawal strategy allows you to confidently transition into this new chapter, knowing that your wealth will support you for the long haul. Embrace the freedom that comes with financial independence, pursuing your passions, exploring new interests, and spending time with loved ones. Whether your dream is to travel the world, volunteer, start a new business, or simply enjoy the peace of a leisurely day, your financial plan is your ticket to living on your terms. As you embark on this journey, remember that your strategy is a living document, designed to adapt with you. Stay engaged, stay informed, and continue to refine your approach as needed. Your commitment to thoughtful planning and disciplined investing has brought you to this point. Now it's time to reap the rewards of your hard work. As we conclude this book, take pride in the knowledge and skills you've gained. You have equipped yourself with the tools to invest like a pro, manage your portfolio, and build a sustainable future. Your path to FIRE is unique, but the principles you've learned will guide you no matter the twists and turns ahead. Here's to a fulfilling, financially independent life, lived fully and on your own terms. Conclusion. Becoming a pro investor on your FIRE journey. Congratulations on reaching the end of this guide to investing for financial independence and early retirement. Your journey through the principles, strategies, and insights outlined in this book marks an important step toward achieving the life you've always dreamed of. A life where your time is your own, your financial worries are minimized, and your goals are fully within your grasp. But reaching FIRE is more than just hitting a financial milestone. It's about adopting a mindset of continuous learning, strategic planning, and disciplined execution. Investing is not a one-time event but a lifelong process, one that evolves with your circumstances, the market, and the economy. As you continue along this path, it's important to remain adaptable, proactive, and informed, ensuring that your investment strategy stays aligned with your evolving goals. This conclusion will pull together the key themes of the book, reinforce the most important lessons, and inspire you to continue refining your approach as you move forward. It's not just about having the right portfolio, it's about cultivating the right habits, maintaining resilience, and embracing the opportunities that come with financial independence. Embrace the mindset of a lifelong investor. The journey to financial independence is not just about accumulating wealth, it's about cultivating the mindset of a lifelong investor. This mindset goes beyond picking stocks, bonds, or real estate. It's about thinking strategically, managing risk, and continuously learning. The best investors are those who view every market fluctuation, every financial decision, and every new piece of information as an opportunity to grow their knowledge and refine their approach. Remember, investing is not about finding the next big stock or timing the market perfectly. It's about making consistent, informed decisions that align with your long-term goals. It's about understanding that volatility is part of the process, that patience is rewarded, and that staying the course often yields the best results. As you continue on your FIRE journey, commit to lifelong learning. Read books, listen to podcasts, follow market news, and engage with the broader investing community. Stay curious and open-minded, and be willing to challenge your own assumptions. The financial landscape is constantly changing, and your ability to adapt will be one of your greatest strengths. Stick to your plan but stay flexible. Throughout this book, we've emphasized the importance of having a clear and well-thought-out investment plan. Your plan is your roadmap, guiding you through the complexities of asset allocation, rebalancing, withdrawal strategies, and more. However, it's important to remember that no plan is set in stone. Life is unpredictable, markets change, and your personal circumstances will evolve. The key to long-term success is to stick to your plan but remain flexible enough to make adjustments when necessary. Review your plan regularly and be willing to make changes if your financial goals, risk tolerance, or life circumstances shift. Flexibility is not a sign of weakness. It's a recognition that the path to financial independence is dynamic, requiring ongoing adaptation. For instance, if you experience a windfall, such as an inheritance or a bonus, revisit your plan to determine how best to allocate this new capital. If the market experiences a prolonged downturn, consider how you might adjust your spending or rebalancing strategy to preserve your portfolio. By staying engaged and proactive, you can navigate these challenges with confidence. Rebalancing, a discipline that keeps you aligned. One of the most important practices in managing your portfolio is regular rebalancing. Rebalancing is more than a technical adjustment. It's a disciplined approach that keeps your portfolio aligned with your target asset allocation, ensuring that your risk exposure remains consistent with your financial objectives. Markets are constantly shifting, and over time, these shifts can cause your portfolio to drift from its intended allocation. When stocks perform exceptionally well, your equity exposure may grow disproportionately, increasing your risk. Conversely, during market downturns, the temptation to shy away from underperforming assets can lead to an overly conservative allocation that hinders growth. Rebalancing forces you to take a disciplined approach, selling high-performing assets and reinvesting in those that are undervalued or lagging. This practice not only maintains your desired risk level but also reinforces the fundamental principle of buying low and selling high. By rebalancing consistently, you position yourself to take advantage of market cycles and ensure that your portfolio continues to work in your favor. Diversification, your best defense against uncertainty. Diversification has been a recurring theme throughout this book, and for good reason. It's one of the most effective strategies for managing risk and enhancing long-term returns. Diversification is not about owning a little bit of everything. It's about constructing a portfolio that balances various asset classes, sectors, and geographies in a way that reduces volatility and maximizes growth potential. Think of diversification as your financial safety net. By spreading your investments across different types of assets, stocks, bonds, real estate, and alternative investments, you create a portfolio that is resilient in the face of market turbulence. When one asset class falters, another may rise, providing stability and preserving your wealth. As you build and manage your portfolio, continuously seek opportunities to diversify. Look beyond domestic markets to include international investments, explore different sectors, and consider the role of alternative assets that may offer non-correlated returns. The more diverse your portfolio, the better equipped it will be to weather market storms and capitalize on a wide range of growth opportunities. Tax efficiency. Maximizing returns by minimizing taxes. One of the most underappreciated aspects of investing is tax efficiency. Taxes can quietly erode your returns, reducing the compounding effect and slowing your progress toward financial independence. Throughout your FIRE journey, prioritize strategies that minimize your tax liability, allowing more of your money to stay invested and grow. Utilize tax-advantaged accounts like 401k, IRAs, and HSAs to shield your investments from taxes. Employ tax loss harvesting to offset gains in your taxable accounts, and carefully plan your withdrawals to optimize the tax implications in retirement. A tax-efficient strategy is not just about the money you make, it's about the money you keep. As you transition from accumulation to withdrawal, continue to think strategically about taxes. Coordinate your withdrawals from taxable, tax-deferred, and tax-free accounts to minimize the impact on your overall tax bill. Consider Roth conversions, timing your capital gains, and exploring charitable giving strategies that align with your tax planning goals. Every dollar saved on taxes is a dollar that can continue working for you. Volatility is inevitable, but your response is within your control. Market volatility is a fact of life for investors. No matter how well you plan, there will be times when your portfolio experiences declines, and it's easy to feel anxious about your financial future. However, your success as an investor is not determined by the markets. It's determined by how you respond to them. Resist the urge to react impulsively to market swings. Remember that volatility is temporary, while your investment horizon is long-term. Stay calm, stick to your strategy, and trust in the principles of diversification, rebalancing, and disciplined investing. The market has rewarded patient investors over time, and it will continue to do so for those who remain steadfast in their approach. When market turbulence strikes, revisit your investment plan and remind yourself of your long-term goals. Tune out the noise of daily headlines and focus on the fundamentals of your strategy. Volatility may be inevitable, but panic is not. By maintaining a level-headed perspective, you can turn market downturns into opportunities rather than setbacks. Keep your spending in check. The true secret to longevity in retirement. While much of this book has focused on investing, it's important to recognize that how you manage your spending is just as critical to the sustainability of your retirement. Financial independence isn't just about having enough money, it's about living within your means and making thoughtful decisions that align with your values. Adopting a mindful approach to spending ensures that your hard-earned wealth lasts. This doesn't mean living in deprivation or denying yourself enjoyment. Rather, it's about being intentional with your financial choices. Prioritize experiences and expenditures that bring you the most fulfillment, and be willing to adjust your spending if market conditions change or unexpected expenses arise. By keeping your spending in check, you reduce the pressure on your portfolio and create a sustainable lifestyle that supports your financial independence for the long term. Revisit your budget regularly, track your expenses, and remain flexible in your approach. A sustainable spending plan is the cornerstone of a successful retirement. Embrace flexibility, the ultimate tool for financial success. Financial independence is not a rigid destination. It's a journey that evolves with time. As you progress through different stages of life, your needs, priorities, and goals will change. Embrace flexibility as a key component of your financial strategy, allowing you to adapt and thrive regardless of what life throws your way. Flexibility means being open to adjusting your withdrawal strategy, tweaking your asset allocation, or exploring new income opportunities. It means revisiting your plan when circumstances shift, whether due to market conditions, personal events, or broader economic factors. Flexibility is your greatest asset. It allows you to navigate uncertainty with confidence and make the most of your financial resources. By maintaining a flexible approach, you empower yourself to respond proactively rather than reactively. You can seize opportunities, mitigate risks, and make strategic decisions that keep you on track toward your goals. Flexibility is not a sign of indecision. It's a recognition that the best-laid plans must sometimes be adjusted to meet the realities of the moment. Celebrate your achievements and enjoy the journey. Reaching financial independence is a monumental achievement, one that requires dedication, discipline, and strategic planning. As you move forward, take time to celebrate your progress and appreciate the freedom that comes with financial independence. Your journey is unique, and every step you take brings you closer to the life you've envisioned. Enjoy the fruits of your labor. Whether it's traveling the world, pursuing a passion project, spending more time with loved ones, or simply savoring the peace of mind that comes with financial security, embrace the opportunities that FIRE affords you. Your investments are not just about money, they are about creating a life that reflects your values, passions, and dreams. As you continue on your path, remember that financial independence is not the end of the journey. It's the beginning of a new chapter filled with possibilities. Stay curious, stay engaged, and continue to refine your strategy. The principles you've learned will guide you, and your commitment to smart investing will ensure that your wealth supports the life you want to live. Here's to your continued success on the road to financial independence. May your investments thrive, your strategies evolve, and your journey be filled with fulfillment and joy. You've earned it, now go out and live it to the fullest.